is on the fairly hawkish end of the NATO spectrum. Estonia is right next to Russia, so when we talk to leaders in the Baltic region, we hear a lot of fairly tough rhetoric, and this proposal for 100 billion euros, at least it goes straight to the sort of scale that Europe would be facing if its main ally, the U.S., falls behind, especially with the funding in Ukraine. When you're talking about EU politics and joint bond politics, that's a whole can of worms. I mean, this joint debt issuance was a fairly taboo subject straight through the Euro crisis, and it was only in the pandemic that they actually pushed it forward. Certainly, you'd have EU governments who would agree to something like this. France is one, but if you look at countries like this one in Germany, it would be a tough sell.
Joe Biden, I think, said over the weekend, he was talking about the fact that there was no panic. There's no kind of fear in Europe about such an event taking place, i.e. the US withdrawing. What is your sense? What was your takeaway from the security conference? Because certainly some of the coverage that I read seemed to suggest that the Europeans are getting very, very nervous now.
Right, I think those words from Joe Biden signal that there may be some panic in Europe because this 60 billion in funding from the U.S. To Kiev is stuck in the House. I mean, it passed the Senate. The House is going to be more difficult. And the strain that that's putting on Ukrainian defenses was front and center at the Munich Security Conference. This was the main topic. I mean, not only was the death of Russian opposition leader Alexei Navalny announced on Saturday when the leaders there were gathered. There was the fall of Avdiivka, which was a city in eastern Ukraine that's been held by Ukrainian forces since the beginning of the war. It's been embattled, and this is the Russian military leveraging their advantage over what the Ukrainians have, which is a lack of ammunition. I mean, this funding, this backing translates into weaponry, and you have Ukrainian units on the front line who are rationing their weapons, and this is a direct result. And of course, the fall of Avdiivka is being used in the U.S. as a message to Republicans to say this is what's going to happen. If the Ukrainians don't get their backing, if they don't get their weapons, they could lose to Russia.
In terms of what came out of the security conference, it feels certainly like the Ukraine-Russia war was dominant, but we've got another conflict obviously taking place. We're watching what is happening in Rafah. That leads us down to what is happening in the Red Sea. We've now got a crew that has been forced to abandon ship. We've got another Houthi attack. Tensions continue to ratchet higher. Your take, what came out of the security conference on what is happening in Israel? What came out in terms of what is happening with the Houthi attacks? What's the latest on that story as well, and how do these two things fit together?
Well, as you say, this was the first instance of a crew abandoning ship based on a Houthi missile attack in the Red Sea. I mean, that's directly affecting global shipping. I mean, you've got freight costs going up. The oil price has been buoyed because these shipping companies are sending loads all the way around Africa, and that's leading to questions about a supply shock. Tensions have not abated. I mean, the Israel-Hamas war was also fairly front and center at the Munich Security Conference, and this just shows where we are. I mean, this tension, this risk has not abated.
And was there a sense coming out? The Israelis are taking a clear line when it comes to what is happening with the hostages. They are saying they must be released, or we are going to take the next steps, and we're going to move the conflict into southern Gaza, into Rafah. The Egyptians are now obviously making preparations for that. What was your take from the security conference in terms of ultimately where that conflict is going? If we were to see the hostages released, would that be enough for Israel to back off? Is this something that is going to be a more enduring conflict? What was the read?
I mean, if anything, there's a sense of heightened concern and a critical perspective on the prospect of launching an attack on Rafah at this point, where you have 1.5 million Gazan Palestinians there. Whether this translates into Israeli action is another question, but it was a matter of huge concern at the Security Conference, not just Ukraine, but you can see how, these interconnected or spiraling conflicts in Eastern Europe, in the Middle East, are sort of really gripping people's attention and a matter of huge concern for world leaders.
Patrick, thank you very much indeed for the update. Patrick Donahue joining us on what came out of the security conference in Munich and what the next steps potentially could be. Let's turn to tech. The big story certainly this week is going to be NVIDIA reports Wednesday. Expectations quite high going into these numbers. This is a stock that has risen circa 50% year to date, and it's February the 19th. Tom McKenzie joins us now. Tom, expectations are epically high.
They are indeed. If we cast our eye back to the November quarter, you saw revenues coming in at around $18 billion US dollars. Now, in terms of revenues, that was up 12% quarter on quarter. It was up 200% year on year back in November.
Yeah.
Whether we get that kind of increase this time round is a key question mark. What Bloomberg Intelligence is saying, that the lead times in terms of the ability for NVIDIA to churn out these chips and get them to their customers has shrunk somewhat. So they think, Bloomberg Intelligence are a little skeptical that you get that kind of blowout result. Nonetheless, the consensus view is you go from 18 billion in the last quarter to about 20.4 billion in this quarter. That's the view. Earnings per share of around $4.57. You've got the likes of Loop Capital Markets, for example, targeting a price for NVIDIA of $1,200. It's currently at $727. We're going to be looking for the different segment breakdown as well. We know about the data centers, the demand there. That's going to be obviously crucial, the outlook, but also the software part of the play and the focus on enterprise and sovereign as well for NVIDIA.
I don't know how you predict going forward for this business. I don't know how it trades on 100 times trailing in terms of the multiple that it's on. Expectations going forward are really high. It would have to continue to deliver and deliver and deliver to justify those kinds of multiples. Yeah. How much visibility do we really have on what comes next from this business? It's clearly accelerated. Sustaining that acceleration, the rate of change is going to be critical.
Yeah, so the bull case is that these data centers that power the generative AI demand that we're seeing, that is, it still hasn't been sated. They're still building out these massive data centers. Yep. You've got all sorts of investors piling into that part of the story as well in terms of the physical infrastructure, and we're still a ways away from completing that and matching the need. And then the other bull case is that you have all these other components that they play to, like combining the hardware and the software. A key question certainly is the China market as well. They get about 25%, just short of 25% of their revenues from China. Obviously, there are restrictions there, whether or not they can adjust some of their hardware, some of their chips to meet and get past those restrictions from the US is going to be crucial as well.
Do they need China? My understanding is that every chip they produce, if it's not China, somebody else is going to buy it.
Yeah. Well, for the moment, they don't, because they can't match that demand for the moment. So for the moment, it's inconsequential. Longer term, it remains a question when you're thinking about 24% of revenues coming from that. The other longer term question is, to what extent does the competition start to catch up with NVIDIA? It doesn't come in this quarter, probably doesn't come this year, but Sam Altman, we know, is scouring the world to raise billions, possibly trillions even, to kind of set up competitive chip makers that can compete with the GPUs from NVIDIA. We heard today from Masayoshi-san, SoftBank potentially looking at $100 billion US dollars. It's a long way off, but the competition story is becoming more present.
The multiples are amazing. Anyway, it's certainly a big day for equity markets this week. Tom, thanks very much indeed for setting us up for us. Tom McKenzie. Quick headline check. Ursula von der Leyen, President of the European Commission, saying in the last few minutes, back to the story we were just covering, we have to increase Europe's defence capability. How that happens, how that is paid for, remains the critical question right now. Quick look at the markets. This is where we sit. US is out today. To be honest, markets absolutely becalmed as a result of that. It is President's Day in the United States, as you can see, therefore, no massive movement. But we'll continue to track what is happening. I'm going to set you up for the rest of the week. I'm going to leave you now. Kriti is going to pick up very, very shortly. She's going to speak to Mark Dowding, BlueBay's Chief Investment Officer. He's definitely worth paying attention to. That's next. This is Bloomberg.
President, let me start with you because you touched on that. You have a very young population. What is your biggest challenge in trying to stay away from the brain drain?
That's an extremely important question, not only for my country, but I would say for the wider region of Southeast Europe. It's so important that, especially for a country where the youth is the majority of the population, there is quality education. And I'm not only talking about traditional kind of education, obviously about skill education as well, that can very much link what universities produce with what the labor market needs, what businesses truly needs. We need to have the kind of economic policies that really produce good-paying jobs. But let me put an additional element here. Young people need hope. They need hope. They need to trust their institutions. They need to believe that the good decisions from which they will benefit and prosper are coming up. So trust in the institutions is so important to instill that kind of optimism that they need to stay in the country, to instill that kind of belief that they need to understand that if they work hard, they will get there. And they can realize their dreams, their careers, and what they need, of course, not just for themselves, but for their families as well as for the society.
Bloomberg has enhanced search on the terminal to deliver what you need when you need it. Now, you can simply type phrases in everyday English in the command line. Compare financials. Find people. Analyze markets. You can enter phrases or ask questions. What do you want to know today? Ask a question or visit SearchGo to find answers now.
Always on the heartbeat of the tech
spread across global markets.
The real-time data aspect is going to be important.
We're going to bring you expert analysis on that. Sure.
Don't miss Bloomberg's interview with the...
From the world of politics to the world of business, every weekday at 5 p.m. Eastern Time, hosts Joe Matthew and Keely Lines deliver news, insight, and analysis live from Bloomberg's Washington headquarters. Get the latest from and about politics' biggest power players at the end of every trading day. Balance of Power live around the world every weekday at 5 p.m. Eastern, only on Bloomberg Television. Context changes everything.
Welcome to a special edition of Bloomberg Markets on this U.S. holiday. I'm told it's President's Day. Happy President's Day to whoever is watching. I'm Kriti Gupta in London. Let's kick it off by getting a quick check on the markets at this top hour. Now, of course, we know the U.S. is on holiday at the moment, but when you look at the European stocks, look, they're open, but they're barely alive is how I'm going to put it. Euro Stoxx 600 virtually unchanged at the moment. 491.54 is where we're at. Some underperformance, though, on the continent. The French and German indexes down about 0.3%. Where you are seeing the outperformance is right here in the UK. So you are seeing it higher by 0.2%. But again, liquidity, volume, it's all going to be low at the moment, just given, again, that U.S. trading volume simply isn't there. That does bring me, however, to the U.S. futures picture, because that futures market is still very much open. You look at S&P 500 E-mini futures, they are, well, virtually unchanged there as well. But 50.22 is where we're at there for that contract. Again, higher by, we'll call it 0.1%. Some slight outperformance in the NASDAQ 100, but again, not seeing much action. What's important to keep in mind is that Goldman Sachs is now talking about a price target of 5,200 by year end. So again, perhaps creating a little bit of optimism off of that call. And of course, as we know, the U.S. market is closed. The bond market is going to be as well. So I'm going to kind of skip over the bond market, even though, of course, it's going to be a key part of the equation. Let's talk about these currencies, though. Euro dollar continues to be in flux. 107.77 is where we're at. They're unchanged at the moment, but if you actually look at an intraday chart, it has been quite choppy throughout the European session. Cable at 126, some dollar strength, dollar weakness there. A similar theme that you're seeing against the Japanese yen, 149.99 on dollar yen there as well. And the Bloomberg Dollar Index as a whole against all the G10 currencies, even against some of the emerging market currencies, broadly weaker. But again, a lot of me is asking, just how much of that is simply a function of that light liquidity? Do we see some sort of different messaging as we get back to normal tomorrow? Of course, this week, one of the key eco data points is going to be that PMI data. I want to kick it off by getting a little bit of a preview from our Bloomberg Euro Area Economy reporter, Alex Weber, joining me. I want to say this morning, but it's actually afternoon, 1 minute and 53 seconds into the afternoon. Alex, a pleasure to have you on the program. Walk us through what we're going to expect from this data.
So the key focus will probably be on the manufacturing side of things. We've been waiting for a turnaround in that sector for quite a long time now. The analysts expect the gauge to pick up just slightly, but still remain below the 50 mark that separates expansion from contraction. So we're still expecting another contraction, both in the UK, Germany, and France. But at this stage, the details really matter. I think people are going to look into it and see if they detect any signs of a turnaround that could ignite some growth in Germany, most importantly, the bloc's biggest economy, and which is very reliant on manufacturing.
What does that then mean in terms of pricing for the ECB here? Are we still sticking to that summertime rate cut? What would change the needle when we look at the data? Or is it kind of all been in one direction, therefore kind of bolstering the argument for what Christine Lagarde is saying?
So the ECB is looking at various things at the moment. It's not just about economic momentum, but also very much about the labor market, which has not behaved as you would expect it to in such a weak economy, because it has remained very strong. Therefore, the ECB is monitoring wage data very closely. We're going to get some of that this week, although a bit backward-looking. But still, it's a very important indicator. And then, of course, inflation, which is expected to be on a very bumpy downward trend this year. So there, again, every monthly reading probably matters. A surprisingly weak reading could sway the mood in the Governing Council toward a cut maybe in April. But that would take a strong downward surprise, I would say. Nevertheless, the discussion is very much alive, and it's going to evolve with every data print that comes in.
Alex, you're sounding just like Christine Lagarde. I need you to be a little bit more exciting. Take a side. Talk to us a little bit then about where the weakness might come from. When we're separating the euro area in terms country by country, there's been a lot of pushback from some of the leaders in Germany as well, saying that Germany is not at all the sick man of Europe. Is it still portrayed that way, or are we looking to, say, France, Italy, even Spain, for those signs of weakness?
I mean, Germany is still the key focus when we're looking at weak euro area countries. France is also not doing that great. The government just downgraded its growth forecast for this year. But Germany, the mood is very bad. The economy may even continue to contract in the first quarter. The Bundesbank just warned, which may put it into a technical recession. Although there again, we shouldn't get too excited over the term recession. It's a very shallow one, not looking very different from a stagnant economy in the broader region. But Germany is very much still the weakest point in the euro area, I would say.
A really interesting dynamic. Don't let the German leaders hear you say that. Bloomberg's Alex Weber, we thank you so much for giving us that preview of the European economic data that we are going to get this week. But of course, let's talk about how you're going to trade it and what that actually means for the markets here. Mark Dowding joins me this afternoon, Chief Investment Officer over at Blue Bay Fixed Income. Mark, a pleasure to have you on the program. We just heard about the importance of this PMI data and simply the idea that Germany is still being viewed as a sick man of Europe, despite a lot of the pushback. Your take on whether that's the right read?
Well, look, I think the picture we've got in Europe is that the Eurozone economy is kind of bumping around the bottom. It's bumping around with next to no growth. I think, frankly, the critical thing in terms of the ECB is going to be the upcoming inflation data that we'll see at the beginning of March. I think a March rate cut is going to be very unlikely. I think that's too soon. But we do see a chance of a move in April, and I think sort of importantly, we are now thinking that the ECB is going to be cutting ahead of the Fed. Clearly in the US, the economy remains rock strong. We continue to see US growth exceptionalism, but from a European perspective, certainly when we speak to policymakers, there seems to be sort of growing concern around downside risks. For example, what happens if Trump wins this election? What does that mean from a European perspective, for example?
Well, you tell me, what does that mean from a European perspective?
Well, it's probably not great news for Europe, is it, if Trump wins? I think that, first and foremost, the idea that you may see the US taking a more insular position, more inward-looking, has got a lot of policymakers we'd speak to in Brussels or Berlin pretty freaked out about the prospects for what that means in Ukraine. It certainly means that countries like Germany probably need to do a lot more to step up to really sort of support the cause if they don't want to see Russia ending up prevailing. So I think that there is a degree of soul-searching going on in terms of European capitals as they game out what the world looks like in a Trump scenario. And for the time being, of course, Trump is looking like the most likely candidate to prevail in the upcoming elections if you look at what's inferred in the betting markets. But otherwise, the fact that the US becomes more inward-looking, I think, is really a moment where, in many respects, Europe needs to demonstrate more leadership and a bit more vigor. And so from that point of view as well, it's interesting to see how historically, whenever we met with the ECB, the focus was price stability, price stability, price stability. Nothing else really mattered. But increasingly now, there does seem to be more of a narrative that actually there's more of a focus on growth and getting Europe growing. And I think that would be a healthy thing if we actually see that changing in terms of Lagarde's rhetoric.
All right, Mark, I want to separate the fiscal from the monetary here and dive in specifically on the fiscal. You're talking about this kind of support or potentially lack of support for Ukraine from the United States. Overnight, we had some comments from the Estonian Prime Minister talking about 100 billion euros necessary in bonds to defend Europe. He's basically talking, or she's, excuse me, basically talking about war bonds or pandemic bonds of some sort, but 100 billion euros. Mark, do we need to be worried about what that does to fiscal budgets across Europe? Is the fiscal more in focus at the moment from that perspective?
Well, clearly, 100 billion euros is a lot of money in anyone's book, right? But I think the one thing to say from a fiscal perspective, though, is that actually sort of Europe has been on a more sort of restrictive sort of fiscal path than is the case in the United States or in the UK for that matter. You look at the US economy, although it's booming, you're looking at a 6.5% sort of fiscal deficit this year, and yet Trump is still campaigning on more tax cuts, isn't he? And you kind of wonder where that deficit would go in the United States if the economy really did start to slow down. But from a European perspective, we have seen sort of a more sort of robust sort of fiscal approach being taken by the different sort of authorities. But frankly, if needs must, if Europe really needs to step up, they really have to step up. I don't really see much of an alternative to Europe needing to sort of be prepared to step in on Ukraine if the US is stepping back. So I do think that in all likelihood, we are going to go in a direction where we'll need to see more spending occur. And I think that this is something that is obviously at the back of the minds of fixed income investors like ourselves in terms of what that means in terms of a risk premium attached to fixed income assets.
Yeah. Okay, so that's the fiscal piece of the equation. So assuming that some of these European economies can actually handle something like 100 billion euros of issuance just to help support Ukraine, let's talk about the monetary piece as well. If you do start to see, say, the ECB front run the Federal Reserve, is there some sort of hidden curveball that comes between the ECB and the Federal Reserve essentially diverging in monetary policy? Is that something that's okay when it comes to the rest of the global economy, or is it better for them to be on the same page?
Look, I don't think in and of itself it's problematic. If you look at the reality here, the US economy is doing a very different thing to many other global economies at the moment. So the fact that policy is a bit different, I don't think should be in itself a very difficult thing. Obviously, we've already got many emerging market central banks cutting interest rates because they were earlier when it came to rate hikes in the first place. Similarly, elsewhere, we're expecting to see Japan go in a completely different direction over the course of the next month or two, with the BOJ set to start tightening policy. In many respects, that sort of policy divergence, I think, will be even more stark. But one thing that you would say here is if we're in a world where sort of rates in the US are being held because the economy remains strong, but you are starting to see rates starting to come down in the context of the Eurozone, that could be something in FX markets that actually leads a bit of a bid towards the US dollar. We know that the US currency is very overvalued on many metrics, certainly when it comes to the price of beer. Way too expensive, right? But the US economy is booming, and so from that perspective, you can see actually from that point of view a bit of a push stronger in the dollar if you keep on that economic performance going.
I like that the price of beer is how you know that the dollar is overvalued. Positioning, of course, is a big piece of that. Mark, a final question to you. Talk to us about your conviction trade right now, just given everything we've talked about on the fiscal and the monetary front. What's the trade? How do you trade it?
So I love being short JGBs here. I think it's a very asymmetric trade. I think you're very unlikely to lose money. I feel very confident that the Japanese authorities are going to move on the back of the wage data. The other market that we want to be short actually is in gilts. I'm kind of thinking that actually UK inflation is stuck a bit too high. It's going to be hard for the Bank of England to cut rates. And actually, with the Tories losing badly in the by-elections last week, if anything, we're going to see the Tories try and calibrate as big of a fiscal giveaway as they think they can get away with. And of course, there's always a risk that they miscalibrate that and markets take a more sceptical sort of approach to fiscal easing than will be the OBR, for example. So on the short side for gilts and JGBs, I think is the right way for the time being. But otherwise, I think it's a little bit too early to get too bullish when it comes to bonds or treasuries. I think markets have been long and wrong over the course of the past month and a bit, and I think there could be a little bit more pain ahead in terms of global yields over the course of the next couple of weeks.
Really interesting dynamic. Your short gilt call is really interesting, given that inflation actually came in softer than we expected just this week. Mark Dowding, of Chief Investment Officer over at RBC Blue Bay, we thank you so much for joining the program, covering a little bit of everything in the fixed income markets. Coming up on the program, we add another element of that. Saudi Aramco saying the oil supply in the global markets is, quote, sufficient. We'll hear from the company's CFO next. Stick with us. This is Bloomberg.
From our studios in New York and San Francisco, our expert hosts have the data and analysis about the companies you know and the startups to watch, plus the interviews you don't want to miss. Watch Caroline Hyde and Ed Ludlow on Bloomberg Technology, the only daily business show dedicated to tech, right in the middle of the trading action. 11 a.m. on the East Coast, 8 a.m. in the West. Only on Bloomberg Television. Context changes everything.
Welcome to Bloomberg Markets. I'm Kriti Gupta. Saudi Aramco may sell bonds this year as financial markets have improved, and the company looks to sell longer-dated debt. That's all according to the state's oil producers finance chief. The CFO spoke to Bloomberg's Vonnie Quinn at the Saudi Capital Markets Forum in Riyadh. Take a listen.
Last year, everybody talks about a challenging market. Last year was our second best year since the IPO.
Well, let me give you two figures. Citi has a price target of $60 a barrel. Bloomberg Intelligence says it would take $108 a barrel for Saudi to balance its budget quite happily. You know, obviously your preference would be for the higher one, but how are you prepared for the lower one?
Well, I don't run the Saudi budget, so what we have is $60 is well above our costs. We have a lifting cost of $3 a barrel. In fact, we started focusing very closely at it because in the past 4 years it has increased from $2.8 a barrel to $3.1 a barrel. I know it's insignificant, but to us it's a trend that we monitor. That is way far. The margins are huge for us to worry about this. So are we prepared for different ranges of oil prices? Yes, we are. And you asked earlier about supply and demand. We think today there is sufficient supply. We think demand has recovered. Last year, the estimates are that demand was at an all-time high, and this year there's considerable growth by all forecasters. The world today is still depending on very little capacity. There's about 3.5%, actually 3% of world production that is in spare, and that is extremely dangerous to continue this into the mid to long term. If you recall, the problems that were had with gas is because gas didn't have any spare capacity. Oil is always a lot more stable, much less fluctuations because there is spare capacity. Well, the world is now down to 3% spare capacity.
Let me get this right. Are you saying we're at dangerous levels of spare capacity?
What I am saying is natural decline is, call it 6%. On 103 million barrels, that's over 6 million barrels per day of capacity that is lost every year that has to be replaced. So that is a Saudi Arabia every 2 years. And if it's a Saudi Arabia every 2 years, we have to ask, where is this coming from? It may not happen, the problem may not happen this year, next year, but if there isn't significant investment in supply, it'll eventually be there. We'll get there.
That was the Aramco CFO joining Bloomberg's Vonnie Quinn at the Capital Markets Forum over in Riyadh. I want to bring her into this conversation. Bloomberg's Vonnie Quinn, of course, on standby here. Vonnie, a fabulous interview there with the CFO of Aramco. Talk to us a little bit about what stood out to you in terms of Aramco's strategy, especially when it comes to that spare capacity question you had asked.
Right. It was a little bit of a surprise, that 3% idea. Kriti, he was basically saying it doesn't have to be Saudi Aramco that makes all the investment in the world, right? So he was saying the oil market is perhaps not taking enough notice of the fact that there is only 3% spare capacity. He was also defending the fact that, there is supply enough to meet demand. There are all these questions about whether the world is oversupplied with oil. I think his point was, look, be careful what you wish for, right? There's a lot less spare capacity out there than the market perhaps is judging or taking notice of. And we've seen that, right? The markets look past all sorts of geopolitical tensions, even the Red Sea troubles. We haven't seen oil jump all that much, even though the Houthis are still active in the Red Sea area. So that was one of the messages he wanted to get across. And of course, also this idea that the maximum sustained capacity had been signaled to go up to 13 million barrels, and that was postponed or deferred or perhaps cancelled. It is now staying at 12 million barrels. Now, that would have been a Saudi government decision, but there were a lot of questions about why that decision was actually made. And I think one of the takeaways is you can tell a lot about what the Saudis think the demand is going to be for oil by the fact that they are not increasing that maximum sustained capacity. They are putting that off for now, and basically it's going to stay at 12 million barrels a day. Perhaps that's enough.
that's the commodity piece of the equation. Let's talk about Aramco itself. If there is this kind of hesitancy to perhaps be exposed to the oil market right now, perhaps you're not actually seeing those geopolitical tensions show up in the market simply because of that kind of fear of exposure. What does that mean for appetite to actually have exposure to Aramco, especially when it's talking about potentially another stake, when it's talking about potentially expanding its kind of operations? How are people thinking about Aramco from a capital markets perspective?
Well, it's a fascinating story right now, Critty, because as we know, we've reported that another stake is likely to go on sale very soon and that Aramco has actually already engaged banks on this matter. Now, this is the special shareholder who is going to decide this, right, who's going to officially announce that, and that, of course, is the Saudi government, who already owns 90% of Aramco, plus if you include the investment vehicle, the PIF, that's another 8%. So effectively 98% of Aramco is still owned by the Saudi government. Less than 2% is floated, but we have reported that another $20 billion worth might come online. Now, he didn't confirm that that was going to happen, but we are anticipating it sometime soon. What he did confirm was very likely to happen this year was that the company issues bonds. Now, that would be the first time in Aramco's history that it has done so. He said it wouldn't necessarily be to support the dividend, but that it would be good for Aramco, it would be good for Saudi Arabia's economy, it would particularly be good for Saudi's capital markets. And indeed, we heard this from the finance minister earlier in the day. He specifically said that equity capital markets in Saudi Arabia have actually become quite healthy and robust. Debt capital markets are what need to be developed from here.
The View out of Riyadh. Bloomberg's Vonnie Quinn is all over it. We thank you so much for bringing us that crucial update. So we go from Aramco right back into a deep dive of the commodity itself. I want to bring in a true expert. Al Nightingale joins me right here on set. He, of course, covers the commodity. We heard Vonnie there talking about how spare capacity, these geopolitical tensions aren't actually showing up in the price of the commodity itself. Why is that?
I think you are starting to see a slightly more bullish tone creeping into the market. We're getting a kind of an emerging backwardation where there's a premium for more immediate crude prices, which is a sign that people are becoming more bullish. Could it be more bullish? Well, sure, but actually what's really changed in the past few weeks? Not that much. There was a big freeze in the US that took some supply off the market. We had some positive numbers from China in terms of the aviation demand, but otherwise things are kind of going along as they were. The Red Sea crisis, or the chaos that we've seen in the Red Sea, hasn't had a supply impact. It's diverted supply, but that just means it gets to where it needs to go later. It doesn't mean it doesn't get there. Yeah. So what's really changed? Not a huge amount, but as the Saudi Aramco CFO was just saying, the kind of demand picture for the year is pretty positive. So there are reasons to kind of have a bullish take.
So the former head of commodities over at Goldman Sachs, Jeff Curry, very famously was the first one to say this is the start of another super cycle in commodities. It feels like that rhetoric has died down a little bit. There are a lot of people who said, no, this is absolutely the start of the super cycle, inflationary dynamics that are going to persist for years, not just months. And that was before all of the geopolitical tensions. Do we still believe in that impetus for a super cycle? If we have strong demand, is it strong enough for a super cycle?
That's a pretty big question, and one honestly I'm not that comfortable answering. I think that there's nothing here and now that makes you go, wow, there's something coming down the horizon that's really huge. You can look at Saudi Aramco's decision on spare capacity two ways. You can look at it as being bullish because there is less room for something to go wrong, clearly. But you can be bearish as well and say, well, why are they not kind of like seeing in the future that there's going to be demand there? There are just different ways to see those things.
Yeah.
I think there's a way to look at things bearishly. So I don't feel like there's a compelling supercycle case.
All right. Well, we'll of course see, because there's this kind of tug of war where the pricing is 83 handle on Brent right here, but it really hasn't returned to that $90, $100 level where people really start to properly freak out. Al Nightingale, we have to leave it there. He of course covers oil for Bloomberg News. Still ahead, we pivot from oil to the tech space. The EU fining big tech again. This is a story you don't want to miss. Stick with us. This is Bloomberg.
timelessness and sustainability go together, right? You can't expect to be timeless if we're run out of resources. So for me, sustainability is not a side activity. It's not a reaction to external pressure. It's core to who we are, what we stand for. And to a very strong extent, it's about future-proofing our business, right? You need to focus on sustainability to recruit. More and more, that younger consumer we're talking about, they want to work for companies that care about this planet, that do more than just kind of generate revenue and profit. You need sustainability to attract consumers. More and more, including that younger consumer, they care deeply about what are you doing differently? How are you making a difference? Investors, particularly in Europe, more and more place value on what you're doing in sustainability. Many of our partners have expectations on sustainability.
Welcome to the world of decentralized finance.
You can see the massive gains for the OG crypto coin.
The breakout we have all perhaps long awaited finally realized. We'll see if it sticks.
Bloomberg's covering all things crypto, the people.
There's no question this industry is composed of some bad actors and some good actors.
The transactions.
Volumes have surpassed $24 billion per day.
And the technology.
Stop talking about the technology, start demonstrating the utility.
Bloomberg Crypto, Tuesdays.
Welcome to Bloomberg Markets. I'm Kriti Gupta. Apple will face a European Union fine close to about 500 million euros over the regulator's investigations. The allegations it silenced music streaming rivals, including Spotify. I want to bring in Bloomberg Intelligence analyst Matt Bloxham to walk us through this story. Matt, this is historic in a lot of ways, but some would say it really doesn't matter because I think the 500 million euros is something like 11 hours of revenue for Apple. Your take?
Yeah, I mean, this goes back to a complaint that Spotify made way back in 2019 about, kind of alleged anti-competitive practices by Apple around its music services in the App Store. And we were expecting the EU to come out with this fine maybe early next month, and we'll have to kind of work through the details of what they actually say. But yeah, it's kind of a bit irrelevant, I think, in a number of ways. One, the fine, even though it feels big, it's not big at all to Apple. The second is that since then, the European Union has moved forward with the various kind of digital legislation, and particularly the Digital Markets Act. Yeah. And you might remember a few weeks ago, Apple came out with a big press statement saying we're changing how we do business in the EU markets, and a lot of what they're changing kind of responds to some of the alleged, anti-competitive practices that were at stake in this case. And obviously the main thing here is that Apple wasn't letting people like Spotify advertise cheaper ways to get the service outside of the App Store. And Apple's making a whole bunch of changes, including allowing people to have their own app stores, not just the Apple one. And if you stay on the Apple's App Store, you'll get lower fees. They'll take a kind of 10 to 15% cut, maybe, on the kind of 15 to 30%. And in any case, Spotify, some years ago, started to move people away from paying for the subscription through Apple. You can't actually pay for Spotify through the Apple service anymore anyway. So I don't think there's going to be any kind of big revenue effect, and the fine is irrelevant. So I think the world has moved on since this case started. And it's the European Commission trying to kind of show its teeth, and that it's really kind of getting to grips with these kind of big gatekeeper technology companies.
I mean, there's an argument here, and I can't remember who said this, but basically, as the European Commission, the CMA even arguably here, trying to kind of rein in big tech, but the fines that they're imposing are simply too small. Matt, as we talk about this kind of regulatory environment where Europe does go harder on big tech, and arguably some of even the bigger companies here in Europe, is there a number that will actually matter to a lot of these big tech names, just given the pace that they're growing at?
I think not. I think what's more important is the change behaviour, and that's obviously what the Digital Markets Act is trying to do and what Apple's responded to. And so we'll have to wait and see whether the European Commission says that what Apple's proposed is sufficient. I think that's the bigger constraint on how they actually operate. I mean, in theory, you can fine a company up to 10% of that revenue. Now, that would be significant, but I think you can imagine if the EU came out and fined Apple 10% of its global revenue, the case would drag on for years and years, if not decades, in the courts. It wouldn't really change things. What matters is kind of strong legislation that forces a company to change its behaviour, and that's what the DMA is trying to do.
I know, it's a really interesting dynamic then, because it speaks to this idea of does this kind of regulatory action even matter until how Apple reacts in Europe sets some sort of precedent for how they react to the rest of the world? And I think that applies to other big tech names as well. NVIDIA, for example, they're reporting earnings this week. On top of announcements overnight of SoftBank investing, I think, $100 billion in new chips. Talk to us about the chip story here. When does the chip story get old?
Never. I think it's the reality.
Not anytime soon.
The world is, completely reliant on technology. I can't see that ever changing, and it's just going to continue to be an evolution, almost like a kind of arms race, if you like, in the kind of technology space. Chips are going to have to continue to get more and more sophisticated. New innovations will come out. So I think this story is just going to keep us going, for decades to come, I think.
A really interesting dynamic. Again, and it speaks to this idea of, if you're talking about this innovation, $100 billion, for example, from the likes of SoftBank, NVIDIA growing into server chips, Apple then kind of rejigging their business. Do you want exposure to it, or is it too expensive? Matt, I'm not going to make you answer that. Matt Bloxham of Bloomberg Intelligence, we thank you so much. He was so excited, just kind of pulled the rug out from right under him. But don't worry, we're going to have someone else to answer that question. Patrick Armstrong, Chief Investment Officer over at Plurimi Wealth, joins me this morning. Patrick, let me put that question to you. Is tech too expensive, or does the pace of innovation at the moment justify it?
It justifies it. But the first part of your question is, it is expensive. We actually sold Apple right at the beginning of the year because it was at 30 times earnings and not delivering much growth. And we bought into NVIDIA, which was trading at 30 times forecast, 12-month forecast earnings with incredible growth. So the stock, NVIDIA, is actually up to 33 times, 12-month blended forward now. It's an expensive stock, but we, like everybody else, thinks earnings are going to be great. There's insatiable demand for the chips. NVIDIA's got the chip that everyone needs, and they have incredible pricing power. So expensive companies, incredible profit margins, incredible growth. So we do think those multiples are warranted.
Incredible growth, yes, but growth that is still decelerating. I'll take another example. We talked about Apple there a little bit, NVIDIA, for example. Microsoft, I think, is one of my favorite examples in terms of big tech that is still growing, but their growth isn't as monumental as it has been in the past. Something like 20, 30% growth in their cloud business wasn't as impressive as, say, 40, 50% that they were boasting at the initial startup of when this also began. How do you monitor when is a good entry point for tech?
The other switch we made right at the beginning of the year, we sold Microsoft and Apple, and we bought Meta and NVIDIA, trying to find more sustainable growth. We think cloud has been an incredible engine of growth for Microsoft, Google, and Amazon, but it is essentially a commodity product that there's not going to be sustainable pricing in it. Right now, it's very hard to switch, but eventually you're going to have to compete on price in cloud, and I don't think that's going to be sustainable outsized profits. It may be sustainable revenue growth, but I do think they're going to have to start competing on price. So I think cloud in the near term is going to become less profitable, even though it is going to have very high revenue growth. So if you are paying 30 times earnings, you do want to have growth. And I think Apple didn't have much growth. Microsoft still has growth, but Meta and NVIDIA were attracted to the growth, even though they are a little bit more expensive with NVIDIA. But even Meta is not more expensive on an earnings basis.
Well, critics of tech bulls like yourself would argue that a lot of the gains that you were seeing in tech right now aren't actually indicative of the growth. It's really more of a momentum play, kind of a moving bus or a moving train you don't want to get in the front of simply because of this AI hype. But Patrick, I'm curious, how do you put a price on hype?
Well, that's the decision we came to right at the beginning of the year. Last year, I was worried about the multiple of NVIDIA, and I was selling put options on it. So you get a big premium to sell a put option on NVIDIA. It's a mildly bullish strategy, and it would force me to buy it on a dip. And that dip never happened. And the PE on NVIDIA over last year, the stock was up 250%, but its earnings were up 1,000% on the forecast basis. So NVIDIA actually got cheaper as 2023 progressed. So year to date, it's actually outstripping forecast earnings growth, but it's not a ridiculous multiple. On a trailing basis, it looks ridiculous, but because the earnings growth is so fast and the profitability, companies are just clamoring to get a hold of the NVIDIA chips. So they can't produce enough to meet demand. That's going to lead to very high profit margins. So 33 times 12-month forward earnings isn't an eye-watering multiple for us. That's a multiple we're happy to pay if there is incredible growth. I don't want to pay 30 times earnings for something that's approaching more like a market multiple growth.
All right, Patrick, let's talk a little bit about some of the macro dynamics that are affecting the tech space. There's a lot of concern about the upward pressure we're seeing in yields. We're looking at a 10-year, obviously closed today, but 427 is where it's hovering at right now. There's a lot of questions about if you continue to see that upside pressure, what level spooks the stock market? What kind of puts an end to this party? What level on yields are you watching to hit the stock market?
So I think we're going to have a yield curve that's as flat as a pancake as we exit 2024, where we've got about 4.5% Fed funds rate modeled, and we think that's where the 10-year yield's going to be. As long as yields are moving higher because growth is outperforming potential growth, the U.S. is probably going to grow at 2.5% this year, which is above its potential growth in the long term. So that growth is going to lead to earnings growth. I think multiples aren't going to expand as 10-year yields move higher, but the companies that are generating earnings are going to grow their way into the multiples they're trading at. So our bull thesis isn't predicated on a wave of Fed cuts. We think the market's coming to our views that the Fed will probably cut 3 times like they're saying. The market was pricing 6 cuts back at the beginning of the year, and growth is just surprising everyone. Services growth, consumption is all very strong. Wage growth is outstripping inflation, and it's still a job seekers market. So we think wage growth is going to continue to drive consumption, and that pushes the U.S. economy forward. So I don't think it's going to be a 10-year yield driving equity multiples. It'll be really earnings growth driving the equity markets through the rest of this year.
How much of that earnings growth then, I'm going to kind of marry the two topics we've been talking about. How much of that earnings growth is coming from the wage picture, specifically in the tech space? And we're seeing headlines over headlines where Apple, Microsoft, Amazon, you name it, are actually laying off so many people. And I think the initial reaction is this is a cost efficiency kind of move. It creates some more wealth in the stock market. Is there an immediate translation in the EPS?
Well, yeah, you can see the cost structure is coming down and the revenue is going up, so it's just a margin expansion. When you've got an oligopolistic or monopolistic position, you set the price if your products are in demand, and that's where big cap tech is. So cutting the workforce is something that just reduces cost. Increasing efficiencies through AI and other technology is something that's boosting profit margins. So the technology companies are on the right side of this, and I don't think the layoffs that we're getting there are going to really impact the U.S. job market. There's still 1.4 job openings for every unemployed person. Wage growth is about 4%. Unemployment's below 4%. So that sets a pretty good backdrop for the U.S. economy.
All right, Patrick, a final question to you. What is your conviction trade at the moment?
Defense stocks, I think, are a great place to be right now. So BAE Systems in the UK is one of our largest positions. NATO spending is going to move to targets, maybe past it. And unfortunately, we're in a world where defense spending is going to stay strong. For the NATO thing I've talked about, we've got wars in the Middle East, Russia, all of these things, countries are going to be spending on defense. So I think you're going to get secular tailwinds on this part of the market. And these companies are trading at 15, 16 times earnings, and I think very consistent revenue growth from here.
All right, Patrick Armstrong, Chief Investment Officer over at Plurimi Wealth, giving us his take on the tech space and then the defense space as well. We thank you so much for joining the program. Lots to digest there. Coming up on the program, we're going to switch into the bank space. Tough times ahead for HSBC. We're going to tell you why the CEO is telling his top executives ahead of this quarterly report. Plus a little bit on Barclays as well. Stick with us. This is Bloomberg.
Let's go inside the boardroom. Let's suppose you win a proxy fight or you just get invited onto the board. You go to your first board meeting, and you're the person who's saying you can fix this company, and all of the others on the board of directors are saying, well, we're doing pretty well. How do you get received when you start saying, here's what I wanted you to do?
Well, first of all, we don't bring that to the boardroom. Our time is spent with the CEO, the chairman, the CFO, and share our plans with them outside the boardroom. we try never to solve an issue in a boardroom. Okay, it's always best done the day before, the week before, outside of that room. We wouldn't be there if they really were doing well. So it's really hard for them to straight face and tell us we're doing well. And we present them with the plan.
This is Bloomberg News Now.
News when you want it at the touch of a button.
Another volatile day on Wall Street. We're seeing big moves.
All eyes on Capitol Hill as Democrats and Republicans prepare.
Today's job numbers casting doubt on the Fed's next move. Inflation remains front and center. And that's news when you want it with Bloomberg News Now. Get it 24/7 on the Bloomberg Business app, Bloomberg.com, and anywhere you get your podcasts.
Bloomberg News Now. Context changes everything.
Or other authorities.
Could face bigger challenges next.
Fed was going to keep reading World Cup. This is a 3
as the economic picture.
covering the intersections of Hollywood, Silicon Valley, and beyond.
Welcome to Bloomberg Markets. I'm Kriti Gupta in London. British lender HSBC reporting fourth quarter results on Wednesday. CEO Noel Quinn painting a pretty grim picture for the year ahead. Let's bring in Harry Wilson, Bloomberg News' finance reporter. Harry, a pleasure to have you on the program. Walk us through this grim year that he's been having.
Yes, so HSBC, probably the most notable thing has been the Chinese real estate problems there. And that's been a problem for all banks with major exposures to China. So we've seen over the course of the last year repeated provisions, write-downs of exposures to the Chinese commercial real estate sector. And although HSBC has recently said it thinks that probably as it's reached its bottom now, it's going to be quite a while before it gets better, and that leads on to making things pretty difficult for them, even though they do have positive tailwinds, like for most banks, obviously the fact that interest rates have been rising.
I mean, those interest rates that you've seen, that really is about helping their net interest margin for so many companies, not just European, not just HSBC, excuse me, but of course, a lot of these European banks as well. But one of the big themes that we've seen in the banking sector has been buyback after buyback. Harry, where does HSBC stand on that?
Right, so they've only just recently completed a $3 billion buyback. That took total capital returns in terms of buybacks to $7 billion over the last year. The expectation is that they could well announce a fresh buyback with the results this week. So markets expecting somewhere in the region, maybe about $2 billion in the next program, and that could well be followed by others. And then on top of that, there's likely to be, will be a special dividend of 21 cents a share. So that's coming from their sale of the Canadian business, which they've sold or are about to complete the sale of for $10 billion.
Talk to us then about some of the bonus pay here. I feel like there's going to be a lot of maybe junior bankers in London at the moment who want to know what's going on with that. Where does HSBC stand on the way that they are really calculating some of the pay?
Well, as we're just reporting today, they've announced a change to their policy on that. So what they're looking to do is benchmark their pay against peers. Now, the expectation would be that that probably means that some people at more junior levels of the bank again get some kind of pay rises potentially and slightly larger bonuses than they might have been expecting. But I think it'd be a wait and see on that. And generally, across the street in London, it's not a particularly pretty picture for bonuses this year. So outside of a few areas, it's unlikely a lot of people aren't going to be seeing much of an uptick in their pay, although HSBC might be one that pleasantly surprises on that front.
All right, Bloomberg's Harry Wilson, we thank you so much for joining us for that update. Of course, HSBC reporting their earnings, I believe, on Wednesday. But it's not alone. Barclays also due to release its report for the fourth quarter. Joining us for a preview of what to expect, Bloomberg's Tom Metcalf all over that story. Tom, let's start there. What do we expect from Barclays reporting tomorrow, I believe?
Yeah, exactly. Tomorrow is 7 a.m. There's two things. Obviously, what happened in Q4 and how particularly is the investment bank doing, because the second element is they have this very big investor update where people are going to be really closely watching what are they trying to do with this bank. So the big problem for Barclays is shareholders just do not value this gigantic global investment bank they have, and executives are just kind of trying to wrestle with how can we keep this investment bank that they very much value, while at the same time bringing shareholders along, and whether that is by expanding the retail side a bit more, or just finding ways to tell the story a bit better almost.
So we were just talking to Harry about the buyback story and the dividend story. We've seen a lot of corporate Europe say to investors, basically, don't leave us. Here's a little something to sweeten the pot. European banks have been all over this. We saw it with Santander, with UniCredit, you name it, Commerce Bank even, putting out these big buybacks. Where does Barclays stand on that?
Well, I think it's got to be one of the levers, or at least it's one of the levers they're expected to pull. So they have obviously been going through buybacks in the past year, but never the sort of shock and awe almost that maybe you might see at a UniCredit or something like that. But of course, it's interesting, anything they decide to give back to shareholders, they won't be able to invest in the business and perhaps make these changes as well. So it's a real balancing act. And then again, you've got the fact that UK banks are a little bit further along this rate cycle than the European ones. So European ones probably in a better position right now to give back a bunch of money, whereas the UK, they're seeing these rates come down. They're realising, hey, we can't keep on, returning capital to shareholders, given we don't really know what's around the corner.
In terms of not knowing what's around the corner, though, we talked to Harry about this as well in terms of kind of net interest margin. And simply the fact that if the rate cycle has peaked, where does that growth come from? Especially for Barclays, which, to your point, has lagged some of its rivals for a very long time. Is there still a little bit of kind of rate growth to squeeze out here, or have they capitalized on that?
I think in terms of the growth, I'll be surprised if certainly there's anything in these results to suggest that. I think where they can focus, and you've seen this with their purchase of Tesco Bank, is, basically build up the other parts of the bank so that the investment bank isn't quite so dominant. So right now it sucks up something like 50-60% of capital at Barclays. And that is something they want to reduce as a proportion. So not necessarily shrink the investment bank, but rather grow the retail side, the card payments, and then they have a bit more recurring revenue, a bit more recurring profit that they can kind of point to, and hopefully that appeases shareholders.
And Barclays is a little bit different because I think when you compare it to the likes of Santander, for example, Barclays perhaps isn't as, I feel like, regionally diversified as maybe Santander might be. So let's go to the Santander story. We had Anna Botín on, I want to say the Markets Today program a couple weeks ago, and she was saying, look, yes, we're concerned about the rate cycle, but take a look at where our businesses are still thriving and still able to capitalize on a carry, pointing to their Brazil business, for example, their Latin America business, saying that that's a rate cycle that's still kind of offering those dividends. Now, this morning, Santander unveiling, surprise, surprise, a $1.5 billion buyback, or billion euro buyback, excuse me, on top of that record profit. When does the party stop for some of these European banks?
Well, what they'll say is that diversification, where they do have other markets in their home markets, will mean, they'll be able to sort of arbitrage whatever's happening in the macro economy. I mean, Santander's a great example. That Brazil market can be a very, very useful thing, but at times it's also been a stick that shareholders have used to beat the bank, saying, hey, this is, it's too risky, or there's, too many sort of provisions there, etc. So again, it's difficult to say, point at Barclays and say, hey, you should be like Santander. I don't think that's what their shareholders want. I think what they do want, though, is a real big sort of, centre that isn't as, up and down, as lumpy as a capital markets business is.
Lumpy. I love that word. But I think accurate in terms of describing kind of how some of this banking story works. One of the kind of details that we've been looking at a lot for Santander, for UniCredit, and these European banks, not necessarily the UK ones, but the ones that have so much more exposure, I want to say, to the United States, is loan loss provisions, and how much of that exposure is being hedged because of concerns on the US. How are people thinking about loan loss provisions and the exposure to the end consumer?
So when you look at UK banks, they've got a good story to tell here. So they're largely not too exposed to US commercial real estate. And so, they will be saying, hey, we learnt our lesson from the last time, we're going to be okay. You go across the continent, you look at a Deutsche Bank, they do have exposure there. Again, I think they had to quadruple their provisions, which goes to show just how much people are thinking about this.
Yeah.
But yeah, as I sit here thinking about European banks, certainly the US commercial real estate is a big problem. But I think it's not directly a big problem. So obviously there's big turmoil in the US that's going to impact Europe, but it's unlikely to be sort of, directly transferable. Oh gosh, Deutsche Bank has lost a lot of money on a certain, office market. It's more likely, the US is sneezing so everyone else catches a cold, right?
Well, it kind of feels like a lot of these European banks are looking at that commercial real estate risk. Are you saying, look, we're not touching it. We had the Commerce Bank CFO who said, we learned our lessons from the global financial crisis. Others would look at that risk and say, well, it's actually isolated pockets. It's not some sort of financial systemic risk. What are you hearing?
Yeah, I think that's the right analysis. Is it doesn't appear systemic right now. It's been described to me variously. It's almost like it's like another regional banks crisis. So, what I would expect to see is not some of the big names. Most of the analysts seem very kind of confident they'll be able to absorb any of these shocks, but it's perhaps some smaller names you might not even know, who might really be overexposed for their size, and then they'll really hit struggles. So it's definitely a live issue. It's going to continue to sort of ricochet around the markets. The only thing I would say is our fantastic real estate reporter has been talking about troubles building up in the US commercial real estate market for years now. So it's kind of interesting to see how sort of dynamic this will be, or will it be a very sort of slow burn, and we'll be talking about it many months hence.
In terms of that slow burn, though, we're talking about this commercial real estate risk, and it's not really something that's being priced in to the markets at all, but would this then, in terms of, again, exposure, would this rattle the European economy as well? Or again, have they been hedged against some of that? Like the Commerce Bank CFO said, we learned our lessons here. What is the read-through at a time when UK home prices are still a concern? The Germany kind of real estate sector is also kind of one that's cracking. We talk a lot about the U.S. commercial real estate sector, but might the European one be a bigger risk? Yeah, I think that is the worry, right? You look at the dashboard, and there's all sorts of worries out there, the ones you outlined just then. And Germany's a great example. Its banks are in some ways exposed to the U.S. market, but maybe the bigger question is, what does its domestic market, commercial property market look like? So no, I think as you look around, it's very easy to be pessimistic if you want to be, and equally you've got people out there very bullish. So I personally kind of went into this year thinking, I think it might be a year of plenty of news, plenty of sort of big losses and surprises. So yeah, I'm kind of looking forward to it, but slightly warily, Tom Metcalf, we thank you so much. I've given him the rapid fire round of all the banking questions, and he's hit them out of this park. We thank you so much for joining us this afternoon. It's 12:55. I'm so sorry. Let's talk about a chart that actually really caught my eye, though, as we talk about this banking sector, and one that is very hard, perhaps, to trade as we talk about the rate story and not. There's a chart that you can access on GTV Co. It's right in front of your screen here, talking about what European banks are actually trading like relative to the broader stock 600. You can see that there is this real discount in terms of how they're traded, despite the fact that if you look at some of their profit margins and the buyback story, they're actually outperforming. So this is a really interesting dynamic. Of course, we're only looking on the price-to-equity ratio. It doesn't take into account the price-to-book ratio at all, but it is certainly one that we are continuing to monitor. In terms of these markets that we continue to look at, because the bond market is closed today because of that President's Day holiday over in the United States. But when you look at the equity market, seeing some marginal gains. The stock 600, 491.58 on there, virtually unchanged at the moment. Some underperformance on the continent, some outperformance in the FTSE 100. The USA markets, though, because those futures markets are still open, 50.22 on those contracts. There's a lot to digest. We've got plenty coming up ahead. Stick with us. More rates, more markets, more geopolitics. This is Bloomberg.
Cryptocurrencies had its critics and still has many critics. Blockchain, nobody seems to be against that as a concept, depending whether you use it properly or not. So you are still fairly bullish on blockchain technology?
Yeah, I've been a bit of a skeptic on cryptocurrencies themselves since inception, and in some ways proven wrong regularly as they have gained in interest and activity. But I've always been of the belief that distributed ledger technology or blockchain technology has applications in the financial services world that as yet are still underexploited.
Do you have a view on whether digital currency authorized by a government is a good thing or not? And do you think the United States is going to be at the leadership of that or following other countries?
It depends. So the benefits of a digital currency backed by a government are potentially greater ease of execution of transactions and greater visibility. If you use the central bank digital currency to intrude upon the privacy of the individual citizen or to eliminate the role of the retail or high street bank from the financial system, then there are potentially very significant implications. That could be a consequence of a central bank digital currency.
happened was you were offered a money-losing women's basketball team, and you said, I want to be in the other sports as well. Is that right?
Well, yeah, you know, you got to be smart about this.
Have you thought maybe I should go do something else? I can't do anything better than I'm already doing. I already turned this company around. I've made a lot of money for the investors, the shareholders, and yourself. Are you happy doing this? You're going to do this for the foreseeable future?
I'm going to do it for the foreseeable future. I love what I do, and the reality is we've accomplished a lot. As you described, we've made Blackstone a lot of money. We made our shareholders a lot of money. More importantly, we've grown the business, and we've been a huge engine of opportunity. If you think about all the jobs we've created around the world, all the communities we've made better places, all the ownership groups who we've helped grow their business, and having built a world-class culture, the opportunities we've created for upward mobility for people. And this business, I would still say, is like a coiled spring coming out of COVID particularly. So I feel like we just have more to do. My job's far from done.
Nobody brings you top names like Bloomberg.
The point is that the economy is doing very well in the Netherlands, but the election was very much focusing on migration.
They'd made 26 attacks. We'd given warning after warning, but we hadn't taken action.
Parliament has to stick to this and has to comply with the debt brake. The debt brake is really a good ally.
I think we have made addressing inequality a key sort of driver of our policies.
Bloomberg. Context changes everything.
Welcome to Bloomberg Markets. I'm Kriti Gupta in London. Let's get a quick check on how these markets are trading. Of course, it is President's Day in the United States, so you are going to see very light liquidity, very light volume on both sides of the Atlantic. Nevertheless, you are seeing the European markets open. Stock 600 virtually unchanged at the moment. Underperformance on the continent with the French and German indexes, but outperformance out on the FTSE 100, higher by about 0.2%. A quick check on the U.S. markets as well, because as we look at these U.S. markets, I think what's really important to keep in mind is that Goldman Sachs came out overnight and actually raised their year-end price target on the benchmark, saying it's going to hit 5,200. Now, we are still a bit away from that level. E-mini futures indicating about 5,022, but you are still seeing a little bit of positivity on the screen. Some would say it's a little bit of autopilot, perhaps an early indication of what's to come as we start to get a full amount of liquidity and trading volume in just 24 hours, I should say, when everyone kind of comes back from the long weekend. NASDAQ 100, though, a little bit of outperformance, higher by 0.1%. As we talk as well about this tech story, the Apple finds that really don't make that much of a difference, the NVIDIA earnings that are coming out, this massive investment in the chip sector that we heard from SoftBank overnight. There is a ton going on in the U.S. equity market. A quick check on the FX market, though, as well, because, look, the nerd in me wants to go straight into the currencies. The bond market is closed today. However, the 10-year did close yesterday about 427, 428 was what we'll call it. Ordinarily, that would mean a little bit of strength in the Bloomberg Dollar Index. We are getting the opposite, not by a ton, but by just enough to create a little bit of a tailwind into the likes of cable. 126 on that rate, but weakness everywhere else. Euro dollar at 107 and dollar yen at about 150. Again, it's the dollar weakness story. We're seeing some really a lot of positioning around it as well. Do we see that continued as we get some of the European data out this week? I want to go there next and get a quick preview on those PMI numbers from our Bloomberg Euro area economy reporter, Alex Weber, joining us for more. Alex, a pleasure to have you on the program once again. Walk us through the importance of this data set.
So we are expecting a small uptick in the numbers for the Euro area PMI. We're especially looking at the manufacturing component of those data because manufacturing has been in decline for a long time after the pendulum swings following the pandemic.
There have been a few tentative signs that it's finally turning around, and analysts are going to pass this data for more signs of that, because it's a key factor behind the weakness in the Eurozone economy. Germany, a prime example here, it's probably going to contract again in the first quarter. France not doing all that much better either. So this is going to be an important data to judge whether the recovery that's been expected is finally arriving.
Alex, everyone's been talking about whether or not Germany is the sick man of Europe. We hear it, research note after research note, saying that it's going to be ultimately the German economy that bring down really all of Europe. How true is that?
I mean, it does weigh on the Eurozone economy. It is the bloc's largest economy, and it has a big problem, which is that manufacturing just has stalled, more or less. There are cyclical reasons for that. There are also structural reasons. That's very much subject of the debate right now. What's causing the current weakness? How long is it going to stick around? That's also why these data points matter to judge whether there's a cyclical turning point finally arriving in the German economy. Are consumers finally spending more money? Is the foreign demand picking up to a sufficient extent? But there are also large structural problems that the German economy is facing.
Alex, when Christine Lagarde and her colleagues look at this set of data and think about whether or not that summertime price cut is still in line, what are they paying attention to the most here?
So this data, the PMI data, are also going to tell us a lot about wage data, the labor market, whether it's still holding up surprisingly well, and also whether the Red Sea troubles are going to have an impact on supply chains and may push up costs further. So the labor market has held up so surprisingly well that you can't only look at economic activity, you have to look at price pressures also from that vantage point. And we're getting a lot of wage data in the coming months. Those are going to be passed for any signs of a cool down. That all feeds into the debate whether the ECB should start cutting rates in April or June. That debate is very much alive. It looked for a long time as if the majority was behind a later start, but the French governor changed that a little bit by suggesting he's actually in favor of starting a little bit earlier. So all these data points matter very much for the debate in the ECB.
All right, Alex Weber joining us from Frankfurt. We thank you so much. A quick preview of that PMI data and what some of the central banks in Europe might actually be thinking. I want to get a little bit more analysis here. When you go from the eco to how it's actually priced in the markets, Pooja Kumar, head of European rate strategy over at Toronto Dominion Bank, joins me right here on set. We thank you so much for joining us. We were just talking to Alex about whether or not Germany remains the sick man of Europe. You're seeing some pushback, of course, from German officials saying, no, that's not the case. Just needs a cup of coffee. It's just tired. It's not sick. How is that priced into this market?
Thank you for having me. I know it's been a talked about topic from all of us, and as you mentioned also, that this time will be basically, I think, the 8th consecutive month that we are going to see PMIs in the contractory territory. Now, I think when it comes to Germany, we, as well as all the economists, realize that there is a structural change that's required, and that's not going to happen in one day. And I think that's why ECB is not just putting all its weight to how German growth is. It's basically looking at the overall picture of Europe, whether it's the bank lending data, inflation, wages, which will also be released in yesterday's data. So I think they're seeing the overall picture, and I will not just give so much importance to PMI just yet. And quite interestingly, even the ECB released a report talking about how PMIs are not the best indicator of growth when any economy goes through a lot of shocks. And that is particularly the case for Germany, I think, which is a very manufacturing-driven economy. And I think that's something that markets should actually realize, that yes, there is stagnation, but I think if things are moderating, it just buys ECB more time. And I think in terms of market pricing, we are still pricing 120 basis points in cuts from ECB, and this compares to something like 80, 90 basis points from Fed. So there is a big wedge there. And
I want to build on that comment you just said. It gives gives the bankers a little bit more time to cut.
I believe so. I hope not hikes again.
Yeah.
I think they want just that, right? They want to get the entire committee at the same page. Luckily, in ECB, we have less of hawks right now. but they want to be patient on wage data. And I think given what we are seeing from US, the sudden changes in the CPI and the momentum, I think ECB will also try to be more cautious. And I think for any central bank and ECB, it's not cutting rates right now. It's basically the financial conditions as well as what's brewing in the rates market. And I think they should be pretty much content with so much rate cuts being priced, right? I think as a mortgager or even a investor as a corporate funding, I'm looking at a 2-year, 5-year bonds, and they are basically pricing a lot of cuts. So I'm in a good position from where I was at least last year in Europe.
We had Mark Dowding over on earlier last hour, RBC Blue Bay Asset Management, saying in terms of his conviction trade at the moment, he is short JGBs, short gilts, but not exactly bullish yet on, or not short or bullish by any means on boons and treasuries just yet. Your take on the short JGB trade?
Short JGB, I think given the fact that April will be last chance for BOJ to actually make some changes to their policy, I think if they do not, I think markets will really give up on that.
Yeah.
I think even if they do change, they make any tweaks, I think as seen from the level of yen, it's all a US-driven market. So I think if treasuries continue to sell higher, trade higher, that's going to make its impact on JGBs, bonds everywhere. Like for example, bonds, we are still trading around 240 when ECB has been dovish, when market expectations are for 120 basis points in cuts.
Yeah.
So I think irrespective of what ECB does right now or BOJ does right now, it's a treasury-driven market, sadly.
Okay, if it's a treasury-driven market, 3 months ago, 6 months ago, there was a big concern about if there's some sort of supply gut, and it feels like the narrative has now shifted to, okay, well, actually, there may not be enough supply for this kind of insatiable demand. Everyone wants to get in on this bond bull run if these rate cuts are getting priced in. Does liquidity matter at the moment?
It does, because we do have 20 basis points moves if there's no liquidity.
Yeah.
I think definitely liquidity matters, and it's surprising, as the point you mentioned, we have never seen this kind of supply in any of these years. And, we were just talking to some clients that why is there no supply overhang in February, right? Generally, you see markets reacting to so much paper. But what we are seeing is the rates are lower, spreads are tightening. I think this is basically the story that Fed, ECB, all central banks will be cutting back. And once they start pushing back, we will be pretty much at levels that we saw in October when treasuries were close to 5%. So I think somewhere deep within, everyone knows that cuts are coming. And any dips are finding bias. Just for an example, last week's retail sales, 1 week data point, markets started to buy treasuries.
Yeah.
But unfortunately, in the next 1 or 2 months, we'll have less clarity, so we will see bounces. But general rhetoric from all of our clients is generally, they're looking at long duration. It's a very evident trade, especially when it comes to flows.
Auctions have been strong on the back of that. Yes, everyone sees these rate cuts are happening. What is the danger of front-running that rate cut?
I think lots of people did that in January, and
I feel like they've been doing that for 2 years. To be completely honest,
that's true. Like we were pricing about 160 basis points in cuts, and now we are at 80, 90. So again, it's a tricky trade, and I think to something that is being discussed, it's better to play spreads right now. Better to play short term. For example, I do agree being a bit short gilts here, just because we are heading towards the remit. When it comes to bonds and USDs, at 200 basis points level, I would actually think that this spread should tighten. So I'm playing ranges right now, and I think that's been the trade for the last 3 years, and that's going to be right now till we get more certainty.
A final question to you. You talked about ranges. You've tempted me here. Give us a floor, give us a ceiling on this 10-year for treasuries.
So when it comes to floor, I think I would look at the floor at treasuries from what floor markets are pricing when it comes to cuts from Fed. And we are pretty much at fair level from their dot plot. So as a result, I don't think there is much upside to where we are sitting. But I think 4% is something that I would look at something floor. You'll get sellers coming in unless we get better clues on when the Fed is cutting. But I think how much higher we can go, that's come to a limit just because the dot plot and what markets are pricing is at fair value.
So what would you, if you had to put a number on the ceiling, what would you put it at? We're at 428 at the moment.
So I think 4 to 440 is something that we are looking at.
Okay, all right. Pooja Kumra, head of European rate strategy over at Toronto Dominion Bank, talking to us a little bit about bond market. I feel like we just did a global tour of bonds. We thank you so much for joining the program. Coming up, we go into a little bit of tech, a little bit of equity. SoftBank's betting on ARM to lead a new $100 billion push to invest in AI products. We'll bring you the latest next. This is Bloomberg. Welcome to Bloomberg Markets. I'm Kriti Gupta in London. Shares of Supermicro Computer are riding on a historic rally fueled by none other than artificial intelligence. Supermicro makes about data servers for chip makers like NVIDIA, and shares have more than tripled since the 1st of January. CEO Charles Lang tells the hosts of Bloomberg Technology about the strong market demand for servers.
Basically, we are able to build enough server for our customer. But now, as you know, the chip shortage. So once we have a more supply from the chip company like NVIDIA, then we can ship more to customer.
Let's talk about the chip makers, the NVIDIAs. But you're kind of agnostic here, right? You take chips from Intel, you take chips from NVIDIA. What are your relationships like?
Okay, indeed, we both companies are founded in 1993. So both companies are 30 years old company. We start to work together almost since day one. So with 30 years relationship, engineering, partnership, and then go to market, define the market spec. So we have been working very closely. However, we hope they have more chip available.
Charles, do you have a number, a dollar value for the total addressable market that you see for your company in the context of an AI infrastructure build-out?
You know, we always facing to a big back order. So the market size is growing. Right? As you know, AI boom basically just start. We believe the market have a big room to grow, and lots of industry leaders have the same feeling. So as of today, our production capacity can support our revenue up to $25 billion, for example. But we need more chip, like what I just mentioned. So again, the market continue to grow, and we continue to get market share because of better product, because of rack scale, plug and play. So we are continuing growing our production capacity in United States and globally as well.
For our Bloomberg television and radio audience, we're speaking to Supermicro CEO Charles Liang. Charles, when we said that you were coming on the program, our audience had many questions. One of them is about the SEC action taken against your company in August of 2020. The SEC charged Supermicro and the former CFO of the company with what they called widespread accounting violations and some numbers presented by the company. Could you update our audience and your investor base on where that process is and if you've put those concerns behind you?
Oh, yeah, those concerns have been behind us for many years. So first, we study detail, hey, where we can improve during that few years.
Charles Liang, the CEO of Supermicro, there speaking to our Bloomberg Technology hosts, Ed Ludlow and Caroline Hyde. I want to stick with the AI story, where SoftBank has announced the creation of a $100 billion chip venture that will supply AI-enabling semiconductors. Bloomberg's Alex Webb all over the story. He doesn't sleep at night thinking about semiconductors, clearly. Tell us what we know. This isn't new necessarily when we're talking about the AI hype, but $100 billion, it's not a small amount.
That's an important clarification here. Unless the news has dropped while I've been walking through the studio, they haven't announced it. Right?
Oh, reported.
I think it's just reported, right? So this is from sources. They are working on a project called Izanagi. They are calling Izanagi. The idea being that it is a semiconductor company that would ideally compete with the likes of NVIDIA. They're talking about a $100 billion investment to make it happen. It's a huge amount of money. 30 billion potentially funded by SoftBank, 70 billion funded by other investors we know not who. It's mooted potentially from the Middle East. This would be a massive play if it were to actually happen. The huge challenge here is how do you catch up with a company like NVIDIA that has been doing this for quite some time? You know, they basically are using expertise that they built up through gaming in order to be the dominant player in AI. There are other companies that have been trying to do this, not least Graphcore, a British company, which had received significant amounts of venture capital investment. Well, some of those investors had to write down the value of those stakes because it doesn't seem to have made the progress that they expected. So it's an incredibly ambitious project if it comes to fruition. How they get there will be a fascinating story to follow.
Alex, you've been covering tech for a very long time. Talk to me about the believability factor when people make these big promises around AI. And the reason I ask is because we had an interview of, I want to say last week, of Relics, which is a UK stock for a global audience that basically does a lot of like legal work, basically legal products. But they've been trying to use AI and cloud and the Internet of Things as a part of their offer suite. As a result of that, a lot of stock analysts have said, well, maybe this is a stock that could really kind of capitalize on the AI hype. That's, of course, a very micro example of this broader theme that we're seeing. How should we be approaching the AI momentum when we're talking about it from a NVIDIA and ARM versus a company that maybe isn't as heavily investing in AI as they are?
Yeah, so Relics, which of course is the old Reed Elsevier business, huge in public, in academic publications. They're sitting on a huge amount of data, which, if navigated effectively, could be a goldmine when it comes to AI. But of course, it's like saying in 1999, I don't want to sound too much of a bull, but like, this is like saying, well, how do I play the internet?
Yeah.
It's that big in scope, right? And there are companies that are still around from the internet era. A lot of them are actually the sort of infrastructure that was needed to roll out the internet. That's kind of the space where NVIDIA and then some of the cloud players are. We haven't yet seen, we don't quite know what the generation of companies built on that infrastructure are going to do. We've seen OpenAI, clearly a big early success story, but likes of Relics are potentially, that's where they're keen to find a niche, right? Because at the moment, we've got these big general companies doing generative artificial intelligence. They are going to be more specialist companies that are really devising solutions targeted at particular industries, at particular solutions, and we haven't really seen those yet. So how companies like Relics can mine their database of information in order to find a project that can yield massive results will be fascinating. Relics has been around for a long time. It is quite a big, slow-moving sort of company. So how they do that will be interesting too.
Let's go back to the ARM story here. Massive rallies in the past couple of days, rivaling some of the kind of moves that we saw early in the tech space with around these AI stories. I'm like looking at this, just gained 30% in the last trading days. That's just the SoftBank story. ARM itself rising over 80%. It's almost doubling in value. Talk to us about the ARM story here. Their IPO was good, but not extraordinary. And now it seems to be picking up steam.
I think the concern or the question marks around ARM when they went public were, is this really an AI company? They were making lots of noise about how they're an AI company. Yeah. It was quite hard to see, certainly from the information that was available at the time, how that was the case. What seems to have been the case in the past few days, the past week or so of trading, pursuant to some of the comments they made around their earnings, is that they do think that the market seems to be buying this story now, that actually there is a bit of a head of steam behind what they're doing in this space. They don't necessarily have the direct exposure in quite the same way that NVIDIA does, but a lot of the stuff they do, the architectures they design, support AI, and I think that is actually now what investors are starting to get quite excited about. At the same time, the stuff they're talking about right now, I remember talking to ARM maybe 6-7 years ago when they were still, actually might even have been before they were taken private by SoftBank. They were talking about the Internet of Things, about being in every single device around the world. Actually, it's sort of the use of those that is now being talked about in the same breath as AI. So in a sense, it's not a new story. It's just the market needs to finally be buying it.
You know, when I think of ARM, I also think of ASML, and not because they're similar in the chip space, but because they both kind of offer something from a business model perspective that there are very few competitors out there. ASML, for example, is these kind of super ultraviolet lithography machines that really nobody else can kind of match. ARM is the same way in being kind of a chip designer itself, but there's very few actual competitors. Why is that not in itself kind of a no-brainer for the stock to shoot up?
Well, because it wasn't entirely sure that they were, the chipsets that they were designing were really the AI ones, right? That they're the ones that are being the accelerators, GPU accelerators that NVIDIA makes that are actually really geared towards AI. Like ARM's very good, and for example, you know, things like mobile phones, right? If you think about Qualcomm, a lot of what they do is really built on ARM designs, ARM architectures, a similar thing with Apple. Just because you're in the chip space doesn't mean you're automatically exposed to artificial intelligence. It is clearly quite a sweet spot to be in, and you are seeing, you know, efforts to compete with ARM and do what they do and maybe take chunks out of their market share, which is also a little bit of a concern for investors around IPO time. We've seen, though, in the, you know, chip stocks rise and fall. It's, you know, NVIDIA was a very small rival to Intel even 5 years ago. Now, it is the biggest chip maker by market capitalization in the world. Intel was the dominant, you know, 300-pound gorilla in the room. Now it looks like, you know, it's kind of struggling at times. So there are these ones. ARM seems to be doing quite well right now. You do hear sometimes a little bit of concern that maybe actually the expectation for ARM is getting over-egged. How can they meet those expectations now that they are rocketing to be sky high? NVIDIA is managing to meet them. ARM, we'll see.
Alex Webb pulling a classic Brit, shedding a little bit of cold water on all the excitement. We thank you so much, though, for bringing that crucial analysis on the AI hype that may or may not be real. Plenty more ahead. We're going to cover the geopolitics developments over the weekend. Stick with us. This is Bloomberg.
I was around so many powerful people my entire life, from the time I got married to Robert Kardashian and had a whole ecosystem of businessmen and entrepreneurs and people running studios. And, any given day it would be the head of a studio and, just often paid attention without really realizing I was paying attention. And I had a very amazing education. I was a housewife. I was raising 4 kids at home. I had the most blessed situation, but at the same time surrounded by these business situations that I didn't even realize were happening right in front of me, but I must have been absorbing it because there's so many times I've like brought up in my mind one of those conversations that I had learned from. And so I think I had a very lucky and blessed existence that way.
Bloomberg has enhanced search on the terminal to deliver what you need when you need it. Now, you can simply type phrases in everyday English in the command line. Compare financials. Find people. Analyze markets. You can enter phrases or ask questions. What do you want to know today? Ask a question or visit SearchGo to find answers now.
Welcome to Bloomberg Markets. I'm Kriti Gupta. The U.S. administration is leaning towards providing Ukraine with new long-range ballistic missiles. That's according to a report from NBC earlier today. Overall U.S. aid for Ukraine, though, still facing an uphill battle in Congress, especially when it comes to the House. Now, Europe trying to figure out how to support Ukraine in the meantime if the United States does indeed pull back on that spending. Bloomberg's Patrick Donahue following the story for us. Patrick, a pleasure to have you on the program. Let's talk a little bit about these contingency plans coming out of Europe. Estonia's prime minister, for example, suggesting 100 billion euros worth of bond issuance is what we need to solve that problem. Talk to us about the reality of that situation.
Yeah, I mean, when you start talking about joint debt issuance in Europe, it's often a taboo subject. That proposal came from the Estonian prime minister, who is on the fairly hawkish end of NATO allies. And so what she was basically painting was a picture of, the scale of what Europe would have to do to fill in the gap of, the U.S., where the U.S. is if the U.S. Pulled out or stood back on its support. But within the context of the EU, if you're talking about joint debt, this is a subject that straight through the Euro crisis was completely taboo. It wasn't until the pandemic hit that European leaders got together and had joint debt issuance to fight the economic impact of the pandemic. Whether they could get back to that, the issue is raised time and again. There are, of course, EU member states who are generally in favor. France, for one, for example. But countries like Netherlands, countries like Germany right here, that would be a very hard sell.
Patrick, talk to us a little then about how some of this, if you do ultimately get the funding that is needed, whether that's the 60 billion in EU aid or the 100 billion in bond issuance, or even that package and spending from the United States, how is that allocated in terms of the actual defense? What does that look like?
Well, from what I understand, what Kaja Kallas was talking about, the Estonian prime minister, was defense needs for European nations, EU member states, to build up their defenses. When you're looking at the 60 billion package, that's direct military assistance to Ukraine. There's some overlap there. But in those terms, the EU, at least at the Munich Security Conference this weekend, the way leaders talking about it have said that the EU has finalized their package. They've approved it. They approved it at the beginning of this month to send 50 billion euros in assistance to Ukraine, and that the U.S. should step in.
In terms of the actual machinery, though, Patrick, a final question to you on this. When we talk about what the strategy in Ukraine actually looks like, there's been some pushback around the usage of drones, or, for example, the United States' new position on kind of long-range missiles being sent. A little bit of hesitation for Olaf Scholz on some of the machinery that Germany can send as well. Meanwhile, Denmark, for example, saying we're going to send all of our artillery to Ukraine. What kind of machinery does Ukraine need right now? Where's most of the pushback coming from? Oh, it looks like we've lost Patrick there for a second, but I just want to kind of really talk a little bit about that defense sector, because as I just mentioned, you are getting a ton of different reads from around the world simply about what kind of machinery Ukraine actually needs. Going back into the United States, one of the concerns around this kind of congressional spending bill is simply whether or not Ukraine is making as much progress on the battlefield as they need. There have been some geopolitical strategists over the weekend who, however, have said that the death of Russian opposition leader Alexei Navalny is actually going to be perhaps the kind of advance and the push that some of the congressional spend needs to actually make it over the line and be able to ultimately be deployed to Ukraine. But then you have to ask yourself, in terms of the EU nations, how much of a fiscal drag could this be? And more importantly, from a financial standpoint, how are investors actually viewing this? I want to go to Chris Turner here. He, of course, is the head of foreign exchange strategy over at ING Bank's London branch to walk us through some of these dynamics. Chris, a pleasure to have you on the program. I want to start kind of the financial side of this story and start with the fiscal allocation that Europe is talking about here. Can Europe afford to help Ukraine?
Yeah, we haven't seen any sort of underperformance or substantial underperformance of European debt on this decision over the last couple of weeks for Europe to push forward with this funding. So, yeah, I certainly think it's going to be the bond market that won't prevent this from happening. So, no, I don't see concerns there.
Talk to us then about some of this kind of defense spend as well. When we're talking then about the geopolitical concerns, how does that factor in from an investor point of view? Some would argue that it's not factoring in at all, Chris.
I think that probably is the consensus view. We are looking at sort of global debt to GDP ratios, which are, high, and obviously concerns around the world of spending, particularly in the US, running very large budget deficits, even during times of sort of economic growth. But we haven't really seen substantial underperformance of bond markets on the back of the fiscal situation. I think in its entirety at the moment, they've largely been driven by the outlook for Fed policy. We do think over time that after the Fed does cut rates, that there will be this fiscal issue in the States, which will prevent, for example, 10-year US bond yields sustainably coming under 10%. But I think that's more of a medium-term issue.
So let's just talk a little bit about the monetary policy here. When we're talking about the ECB, when we're talking about the Federal Reserve, one of the concerns initially with the onset of the war in Ukraine, kind of in addition to some of the pandemic issues that you saw, some of the supply chain concerns were around commodity pricing and what that would then mean for the inflationary dynamics. Is there a read-through from the geopolitics into the inflationary dynamics 6-12 months down the road?
I think not yet. I think, if you look at the situation in the Middle East, energy prices, oil prices have sort of nudged up, but like gas prices remain on their low. And I think we are looking at, obviously, container rates having nudged up, but nowhere near like the shock we saw in 2022. And I think the issue is, as long as sort of oil supply and like the Straits of Hormuz doesn't come into the equation, I think the market is focusing on the classic issue of, slowdown in activity. Obviously, we've seen sort of headline inflation come lower across the world, and we're very much focusing on the sort of sticky services inflation, particularly in the States, where we had that sort of upside surprise last week in rent. It's probably a consensus view that was a blip, and actually the core trend should be lower. So I think disinflation trends, will really dominate this year.
In terms of that disinflation trend, though, we're seeing them at different paces. And just like the last 7 days, for example, we got that US CPI data. We also got UK CPI data as well. One was a hotter print. One was a much softer print than we were expecting. That divergence between the two, is that a point of concern to you?
Not really, no. I think the direction of travel looks clear, and I think you see that in investor surveys as well. They really are convinced that short-term rates will come lower and central banks will have the room to take interest rates back to more neutral levels. I think in the UK, it's really an issue of timing. And probably in the second quarter, I think it'll become a lot clearer that the UK disinflation trend is following what's happening in the US and Europe as well. So maybe there's a few months, for example, where they don't fall, hand in hand in line with each other. But I think on a quarterly basis, I think this year's story will be one of a disinflation trend.
Where does the spook factor come in, though? What are we waiting for maybe central banks for investors to say, hold on a second, maybe we're not making the same kind of progress that we want to be making?
Yeah, I think it's a good question to ask because volatility levels across markets, across bond markets, so interest rate markets, equity markets, and FX markets, are historically very low. In the FX markets are probably the lowest level since before the invasion of Ukraine back in 2022. So, the risks are there. Where are those risks going to come from? I think we would think on the inflation side that we are quite confident that prices will come lower. I mean, maybe it is some other sort of geopolitical shock that emerges from somewhere. It's quite hard to tell. Obviously, if you listen to obviously the IMF and others about financial stability risks, there remain concerns over obviously the commercial real estate sector, and obviously China as well, sort of comes into the fray at the moment. But at the moment, it's sort of like seems that it will be the unknown that kind of causes some troubles down the road. From what we can see at the moment, it looks like this benign environment should allow central banks to really start easing policy probably around the summer.
So let's talk then about the translation into the FX space here. When we're talking about kind of this positioning that we're seeing, I got to say, I started this year saying this kind of strength that we're seeing in the euro, strength that we're seeing in cable, 107 on euro, 126 on cable, that cannot sustain when we're talking about broad European weakness and this kind of strength in the consumer over in the United States. And yet it has persisted almost 2 months, Chris. When does that winning streak snap?
Yeah, well, I think it's interesting, instructive, last week's price action, right? Because we had the upside surprise in like US CPI, short-term rates jumped higher. You would have thought the dollar would be able to hang on to those gains that it saw last week, but it didn't. And I think that goes back to what I was mentioning a bit earlier. I think there is a conviction view that US rates will be coming lower this year. And that window of price action that we saw in November, December last year, where we saw a bullish steepening of the US yield curve, where US short-dated rates fell more quickly than long-dated rates. We think that will be the story. That is a good story, but it's probably not something that emerges until Q2. So I think that's one of the factors why euro-dollar, when it did break down to like 107 last week, there wasn't any follow-through. And if you look at, as I say, like 1 week volatility in the euro-dollar market, it's exceptionally low. And I think people are really reluctant to kind of chase breakouts at the moment until they get a conviction story together. And personally, I think maybe in March, if the February CPI print in the States does come a bit low, I think that might be a window where the dollar bear trend gets to resume.
Well, what levels are we talking about here? Put a number on it for us. 12 months, what does euro-dollar look like?
Yeah, so we think, and we've been saying this since last November, that we felt don't expect a big dollar decline in the first quarter of this year, basically. And normally, January and February are strong months for the dollar. So I think we've got to accept that and ride that out and don't expect any sort of dollar weakness coming through over the next couple of months. But we've really probably got the bear trend starting to sort of show its face in the second quarter. ING expects the first Fed rate cut in May. And we're actually slightly above the Bloomberg consensus, which is 112 for the end of the year for euro-dollar. We're actually up at kind of 115. And there are challenges, and we've got a lot of corporate customers saying, well, the ECB will be cutting rates as quickly as the US, while you think euro-dollar needs to go higher. But I think if the Fed does finally start to bring rates lower, that should be good news for portfolio flows out of the dollar into more interesting portfolio opportunities around the world, including emerging markets. And in reality, we haven't seen a big flow into emerging markets for 3 or 4 years.
So if I'm hearing you right, it sounds like it's more of a positioning story rather than kind of a European eco story that's driving your call. Am I getting that right?
That's right, yeah. And I think the global investment environment, when you do get bullish steepening of the curve, it's generally good for global activity. If you think about it, you get lower US rates. Trading partners around the world are allowed to cut rates as well. I've already seen that, in Latin America, they've started to preempt the move, haven't they, in terms of delivering very large rate cuts in Latin America already on the view that perhaps the dollar has nearly kind of peaked. So, I think global growth prospects where we stand now, there is opportunity for them to be revised higher if the Fed does cut rates this summer. Our Eurozone team, they would describe the Eurozone economy as stagnant, but actually even they, who have been quite sort of negative for some time, are starting to look at a little rays of light, perhaps real spending. There are opportunities slightly on the upside there. Perhaps inventory levels have sort of corrected far enough that can support sort of manufacturing production going forward. So yeah, I think probably as the FX market's the most efficient one in the world. Euro-dollar is fairly priced right now, but I think the next story for the next couple of quarters will be a weaker dollar.
Euro-dollar might just be the most fairly priced. The take out of Chris Turner of ING Bank's London branch. We thank you so much for joining us this morning. There's a lot to digest in terms of these markets. Of course, geopolitics at the forefront of a lot of the investor mindset. We continue that conversation, this time with Israel setting a firm deadline before continuing an attack in the Gaza city of Rafah. We get the latest on the war in the Middle East next. This is Bloomberg.
Timelessness and sustainability go together, right? You can't expect to be timeless if we're run out of resources. So for me, sustainability is not a side activity. It's not a reaction to external pressure. It's core to who we are, what we stand for. And to a very strong extent, it's about future-proofing our business, right? You need to focus on sustainability to recruit. More and more, that younger consumer we're talking about, they want to work for companies that care about this planet, that do more than just kind of generate revenue and profit. You need sustainability to attract consumers. More and more, including that younger consumer, they care deeply about what are you doing differently? Are you making a difference? Investors, particularly in Europe, more and more place value on what you're doing in sustainability. Many of our partners have expectations on sustainability.
From the world of politics to the world of business, every weekday at 5 p.m. Eastern Time, hosts Joe Matthew and Keely Lines deliver news, insight, and analysis live from Bloomberg's Washington headquarters. Get the latest from and about politics' biggest power players at the end of every trading day. Balance of Power live around the world every weekday at 5 p.m. Eastern, only on Bloomberg Television. Context changes everything.
Could face bigger challenges next.
It was going to keep Green World Cup. This is a 3
as the economic picture
covering the intersections of Hollywood, Silicon Valley, and beyond.
That's it.
Welcome to Bloomberg Markets. I'm Kriti Gupta in London. Israel sending a warning to Hamas, threatening to launch an attack on the Gaza city of Rafah unless hostages are released by Ramadan next month. Joining us now is Alyssa Audenheimer, joining us from our Tel Aviv bureau to walk us through the story. Alyssa, what do we know here?
Well, it's really quite interesting because until now, of course, Israel has been saying, please release our hostages, but hasn't given a deadline. And there's been negotiations. Israel has said that Hamas's demands are delusional, are just way too high, and that it will refuse to meet them. But now it's saying, look, we are going to have to go into Rafah. That's where the remaining battalions of Hamas are hiding. Now, the problem is that there's also about 1 million refugees, Gazan civilians, who have moved all the way from the north where the fighting started, and were told by Israel to move south to get out of the way so that they wouldn't be hurt. And now they're in Rafah. So what we have is 1 million Gazan civilians there, plus we've got Hamas hiding among them and, of course, underneath them in all the tunnels. And this is the problem.
Alyssa, talk to us about the broader fallout here as we talk about those peace negotiations that have been in place for a while. Reports that Israel has backed away from any sort of agreement. Benjamin Netanyahu talking about them, the demand simply being far too much for them to kind of put up with. What do the negotiations and prospects for peace actually look like?
Well, Israel has said that it won't end the war until Hamas is defeated. That means that that either Hamas has to surrender or be defeated by war. Those are the choices. And it also won't end the war before all of the hostages are returned. So this is the difficulty. Israel says that if it allows Hamas to stay in place, then it has lost the war, and it can't lose the war because it will appear very weak and will invite further attacks also from Hamas and also from the other Iranian proxies around Israel, including Hezbollah, which has already been attacking Israel from the north, from Lebanon.
All right, Alyssa Odenheimer, we thank you so much for bringing us that update on just the kind of offensive that Israel is considering in terms of Rafah. And we should mention that there is still, of course, a humanitarian situation in Gaza City that a lot of world leaders around the world really have their eye on. But it's not just between Israel and Gaza. Of course, the conflict has spread out to the rest of the region. I want to switch gears to the Red Sea, where for the first time, a commercial cruise ship is abandoned following an attack from the Houthis. For more, we are joined now by Bloomberg's Alex Longley, who joins us from our oil team. Alex, there's a lot to digest in terms of reports like this. Traditionally, when we see this kind of move, in terms of the geopolitics, in terms of reports like this, there's a bigger reaction in the markets, a bigger reaction in oil. Your initial take on a report like this?
Well, I think throughout these attacks, we've had a few milestones. I mean, the first one was the landing of a helicopter on the Central Park, which is a car-carrying vessel which remains anchored off the coast of Yemen. In addition to that, we then had this oil tanker which was attacked and caught fire about a month or so ago. And as we see this kind of escalating pattern, this attack today, which has seen for the first time a crew leave a vessel, that's a significant milestone because it tells you something about just how severe these attacks are getting. Now, we don't know the damage to the vessel. We don't quite know what's going to happen next. But in terms of the markets, I think we're becoming more accustomed to these impacts. And also, we're seeing a lot of the trade flows already rerouted. Once you've sailed the long way round, you kind of know what's going to happen. I mean, a lot of the times we see this compared to the Suez Canal disruption in 2021, right? Yeah. The main disruption there, the main shock, was the fact you couldn't get through. And global trade was already on its way through the Suez Canal at that point, and we didn't know how long it would last for. I think now people have made contingencies. They know that ships are going to have to go the long way around. And that's why you see these kind of more muted reactions, even as we see crews abandoning ships right in the middle of that Bab el-Mandeb choke point.
You've seen a lot of these commercial ships now reroute, to your point. That means more fuel, more labor, increase of 40% of voyage time. You're hearing from a lot of corporate, European and corporate America CEOs saying, look, we got through the pandemic and the supply chain issues of 2021. This is nothing in terms of rerouting some of the supply chain. But there are costs associated with it, even for oil tankers and even for oil prices as well. Why does it not show up in the oil price?
I think there's a few things. The market, up until recently, was generally deemed to be in balance. If you talk to traders, you'd get pretty lackluster responses. The view was, well, supply is more or less equal to demand, give or take. There's nothing to get excited about. So you've got exogenous factors there. You've got a demand picture in China that's a little bit lackluster. You've got relatively healthy supply growth from the US, from non-OPEC countries like Brazil and Guyana, and that's got a buffer in the oil price, but it's backstopped to the downside by OPEC+. I think where it gets more interesting on oil is the tanker side. You're seeing now the slow impacts into tanker freight rates. You're seeing super tanker rates lifting in the Middle East. And that's because these trades are becoming disjointed, because people are having to source barrels more locally, because tankers are out of position and things like that. So I think while you're not seeing an impact necessarily on headline crude prices, I think the place in the oil market where you are going to see an impact in time is going to be in the tanker space. And when the tanker space starts to move, you do start to impact oil trades as well, because that affects how far certain barrels, like WTI in the US, for example, how far you can send that away from where it's produced.
So let's stick with the U.S. story here. They are now the #1 exporter in the world of oil. To your point, you do have OPEC Plus kind of backstopping these prices as well. How much lower can that push? How realistically is that oversupply from the U.S. really being taken when, and I think you taught me this back in the day, which is that WTI and Brent, it's light crude versus dark crude. It's not the same, or heavy crude, excuse me. It's not the same actual product. So it doesn't even matter that the U.S. is the #1 exporter of oil.
Well, I think, and in some ways, from then to now, one of the things that's changed is the addition of WTI into the Brent benchmark. So these two benchmarks that were once completely different prices are now very commingled. And that, in part, is why we saw such a drag on prices from that higher US supply late last year. I think to the question of how significant is the US, hugely significant. I mean, it is the market's barrel of last resort, particularly after the invasion of Ukraine and Europe's move away from Russian supplies. But even then, I think you've had time for slack to develop in the market. You've had time for extra barrels to come on elsewhere. And we focus a lot on the US, rightly so. But there are lots of small additions, or sort of medium-sized additions is probably a fairer point, in the likes of Brazil, Guyana, Canada. Norway has a giant field that has steadily ramped up over the last 2 to 3 years. And lots of those barrels don't go away. And I think that's the other element to it, is you add 200,000 barrels a day, it doesn't sound a lot, but if you add it in 5 different places, it's 1 million barrels a day, and that can be annual demand growth in some years.
So what's the spook factor for this market on the upside or the downside for an oil market that has been trading in a range for months now and really hasn't broken past, I want to say, like $84 on Brent or a drop of, I'm going off my head here, I'm going to say at least 76 on the downside. What breaks it out of that range on either end?
Well, I think the big unknown is China, and I think the big sort of uncertainty going into the second half of the year, we've had an oil market that's been burnt too often in the last 6 months, and people are wary of deploying that capital. And China is the big unknown with that. You know, if we have an amazing second half in China, oil looks great. If we have a dreadful second half, oil looks a big worry. I think that's a kind of a big, obvious one. In the short term, I think we run the risk of having little spikes. We're seeing it now at the front of the curve. Things look very tight. And when, for example, demand surprises to the upside in a way perhaps in the macroeconomic environment people don't expect, I think that's where you can get sort of a mismatch between sort of the wider sentiment of, well, can oil demand with a gloomy China, with questions about where rates are going to go, can oil demand remain robust for the rest of the year? And what we've seen throughout the last sort of 18 months or so is, for the most part, demand has ended up being okay, even when forecasts have been gloomy. Yeah. And I think that's another element that sort of the mismatch between those two is something that both traders and analysts kind of find themselves being confounded with regularly.
A fun time to be an oil trader, I imagine. Bloomberg's Alex Longley explaining those really crucial dynamics of what we're seeing in the crude market that really on the surface feels like it's kind of asleep at the wheel, but as he explains, there is a lot more to it. A quick check on these markets here, because you are seeing, well, fairly so, Stock 600 not moving a ton either, virtually unchanged at the moment. Underperformance on the continent, outperformance right here in the UK. That does it for this hour. More market coverage ahead. This is Bloomberg.
From our studios in New York and San Francisco, our expert hosts have the data and analysis about the companies you know and the startups to watch, plus the interviews you don't want to miss. Watch Caroline Hyde and Ed Ludlow on Bloomberg Technology, the only daily business show dedicated to tech, right in the middle of the trading action. 11 a.m. on the East Coast, 8 a.m. in the West, only on Bloomberg Television. Context changes everything.
Women, on average, have about a 30% lower, I guess, amount of money saved up for retirement compared to men.
Yes.
So what are you doing about that?
Yeah, so we launched a campaign called Retire Inequality. And we do know that women retire with 30% less. Women make 83 cents on the dollar. And so there's a couple of things that we're doing. One, it's having this conversation and making sure that we all are aware that there is a gap. By the way, women live longer than men, so longevity risk is a real factor. Secondly, it's about making sure that we are talking to women about what can you do differently. And so whether that's negotiating pay and what are some tools that are out there, making sure that you take the time to negotiate, because we know women do not negotiate as much as men, which puts you at a disadvantage to start. But then also along the way, making sure that women are securing their own retirement, and that as part of their retirement plan, we're having much more conversation around guaranteed income as well. And so ensuring that we understand what are the nuances for women. If you think about COVID, 2 million women exited the workforce. They did not continue to contribute to their 401k or 403b plan. And so how do we make sure, as a matter of policy, as a matter of engagement, that women can have an opportunity to catch up? That women can understand that if you exited the workforce and now you're back, that that's 2 years of compounding that you were not able to take advantage of. And how do we continue to make sure that we're educating them and giving the tools that they need to get back on track?
So let's go inside the boardroom. Let's suppose you win a proxy fight and/or you just get invited onto the board. You go to your first board meeting, and you're the person who's saying you can fix this company, and all of the others on the board of directors are saying, well, we're doing pretty well. How do you get received when you start saying, here's what I wanted you to do?
Well, first of all, we don't bring that to the boardroom. Our time is spent with the CEO, the chairman, the CFO, and share our plans with them outside the boardroom. We try never to solve an issue in a boardroom. Okay, it's always best done the day before, the week before, outside of that room. We wouldn't be there if they really were doing well. So it's really hard for them to straight face and tell us we're doing well. And we presented with the plan.
I'm Kriti Gupta in London. Welcome to a special edition of Bloomberg Markets on this U.S. holidays. Of course, President's Day in the States, which means bond markets are closed, but the equity markets also closed, but the futures market is giving us a little bit of an indication. Start in Europe here first, though. Stock 600 higher 0.1%. Nothing to get super excited about, but on a regional basis, seeing underperformance in the French and German indexes down to the tune of 2 3/10%. The outperformer is the FTSE 100, higher by 0.2%. But again, light liquidity, light volume, that seems to be the story in these European benchmarks. I want to get a quick check on futures as well, because they are broadly positive. But again, light liquidity, light volume, I can say it over and over again on every single market that you are seeing today, perhaps snapping back into action when we come back to the trading desk tomorrow. Nevertheless, you are seeing E-mini futures at about 50.24 on those contracts. Remember, coming right off the heels of a Goldman call that their year-end price target getting to 5,200, all on profit margins. Those futures higher by 0.1%. Outperformance in those NASDAQ 100 E-mini futures. And then let's go to the currency picture as well, because even though the bond markets are closed, the currencies are doing something interesting. I started off this year by saying that perhaps there was some dislocation in these markets. Right now, you are seeing some broad weakness in the European currencies, but broad weakness in the dollar as well. Some interesting dynamics that I'm sure our next guests will be all over. But right now, euro dollar at 107, cable 125, we'll call it 126 just to be generous. Dollar yen 149.96, and of course that Bloomberg dollar index virtually unchanged at the moment. Let's get right into these very, very exciting markets that we are seeing. Bloomberg's JP Barnard joins us, as well as Marcus Ashworth over at Bloomberg Opinion. Thank you guys both for joining me this morning. Marcus, I want to start with you here and talk about this currency picture. It's very confusing to me why we're seeing kind of the sustained strength in euro, in cable, despite rate cuts, European weakness, PMI data, continuing to say that not really justify those numbers. When is it going to snap?
Well, I mean, we're in a trendless environment, I would say, largely. We've been stuck in sort of mid to high 120s for cable and a just below 110 dollar-euro picture for some while now. And I don't really see anything majorly changing on that because the dollar's strength is just what permeates through everything, because it looks like the Fed aren't going to be cutting rates certainly this quarter, or even into even in May is now at risk. So in that sense, that's all that matters is the dollar value, and it does seem as though the Fed is holding tough. What is surprising to your point, though, is that with the weakness in European growth and now clearly UK growth, we haven't really seen much of an impact on their valuations of the euro, and not necessarily to themselves, but to the dollar. And I wonder if that's because obviously they've clearly viewed the Bank of England is right in holding its unbelievably tough line. I don't think that's going to last, but for the moment, that's what's keeping sterling up. For the euro, again, I don't really understand with the weakness in the currency, but I guess not a rate cut opportunity till June seems to be the mantra from the European Central Bank. Everyone's believing it at the moment. Everyone's believing in central bankers, which is a worrying state of affairs.
I was about to say, that is quite the vote of confidence.
Believe in them. Yeah.
Everyone's giving that vote of confidence except for Marcus Ashworth. JP, hop on in here and talk to us about whether or not this is ultimately a dollar story. Feel free to opine on whether or not we should believe the central bankers.
Well, I was just laughing because, like, believing the central bankers, I mean, that's also a thing that the market was never really right in predicting central banks, and I feel like that central bankers also were never, like, really right to predict the market or predict the economy, because it's not, I'm not blaming them for it, it's just such a difficult thing, and especially now we have so many moving parts in this market with everything going on, from the still, like, a little bit flaming of inflation. It's not, like, fully tamed right now. We have the whole topic of bond supply, rates being high and causing ripple
macro effects in all kinds of corners of the market. We have still a weak economy in China. We have geopolitical tensions all over the place where you never know when they're going to flare up. And then you have like corporate earnings, which also like are very hard to predict. They are very solid so far, even though we lowered the bar of our estimates like substantially. And that all in all, it makes it a very, very hard thing, I would say, like where the market is going, especially the equity market, to make a correct prediction for 2024 where we're moving. And so like putting too much belief in that central banks will be spot on and totally right with the timing and everything, I really struggle to make a case for that one.
JP, does the equity market even care about the macro right now? And the reason I ask is off that CPI report that we got last week, even off the UK CPI report that we got last week, the stock market only dropped, say, 1% on the S&P 500. That is nothing relative to sensitivity we've seen on the data in the past. So I guess my question to you, in light of the Mag 7, some of these big bank earnings, record profits in oil, does the macro even matter?
Well, I would say it does matter in the heads and minds of all the people, at least the people I speak to. And when you read through the analyst notes and commentary from portfolio managers, they do still care about the macro picture very much so. They have the problem, though, that everybody is like underinvested in this rally for 3 months now. So what they're doing is like, yeah, I mean, the macro picture is not looking like too rosy. It's okay, but not great. But I still like lack the exposure, especially in some of the hot markets of the hot areas of the market. And so they go like, I mean, let's gamble here a little bit. And you see this like massively with the really like hateful behavior towards put options in the market and a massive demand for call options, especially given they are so cheap that everybody's trying to chase this market. And it's like not pushing aside the macro worries or even like the micro worries when it comes to earnings, but going like, yeah, I can't help it. My exposure is still too low, so I have to grab the market higher, even if I'm not fully convinced about the equity story.
It does feel like a momentum trade at its core. Marcus, hop on in here. When JP there said this market is underinvested in some ways, you nodded your head.
Yeah, well, I actually think your point was right as well. And the macro doesn't seem to be affecting anything at the moment. It's trendless in the wider sense. And that's creating an odd environment where I think the market wants to be risk on. And certainly equities are, as you said, shuttering off, some macro worries out there. Bond markets are a little bit more freaked out by what they see as central bank blocking and holding on rates. So that's causing the problems. I think towards the end of the year, or certainly by the summer, I expect bond markets to be lower in yield, as I think there'll be more economic weakness. The macro play will get a little bit more clear. But I think that definitely the views are as far as wanting to put money to work in areas like Japan. It's still evidently in US tech. Barring a nasty set of numbers for NVIDIA maybe later this week or something like that, there's clearly people want to have risk on. It's the start of the year. People want to invest. They want to see markets go higher, and a little bit thwarted perhaps on the currency and the bond side of things. But equities are who cares? They don't play the same drum. Earnings are holding up, and they've got money to invest.
But if rate cuts are kind of the consensus view that they're going to come, maybe not now, but eventually.
Yeah.
But that is it feels like a given now when it wasn't, say, even a month ago. Why is this bond market not responding? Why are people not piling into bonds right now?
I don't know. It's frustrating me, really. I think it's a great buy, and I think it's just taking a bit longer to filter through than I had hoped. And I certainly think there are some opportunities where we will be repricing substantially by the end of the year. But for the moment, everyone's just looking, okay, instead of 5 or 6 rate cuts, it's only going to be 3, and everyone's got them positioning out of whack here.
Yeah.
And I think that's why we got money still happily going to the equity market. Bond markets, we've seen a very big supply, actually, and taken down fine, both huge on sovereigns, but also, we had Siemens last week and a €4 billion trade. Pepsi Cola in the States had some interesting trades going through. There's a lot of corporate activity starting to come through. Investors want bonds. They want high yield, and they want corporate, yield, decent, triple B investment grade yield stuff. So in that sense, there is money certainly going to work. It's just there's a lot of supply holding back government bonds at the moment.
Marcus, I'm putting you on the spot here. What comes first, 4.5 or 3.5 on the 10-year?
Oh, I'm going to say a brief touch of 4.5 before it goes to 3.5.
All right, JP, I'm going to put that into the stock market, though. If you're concerned about yield hitting 4.5, do we then see some sort of ripple effect into the stock market, or is that a 2022 story?
Well, I don't think that we see a ripple effect here for the stock market. I mean, like, stocks have been like fairly comfortable now with the higher level of yields. There are still some issues in the banking sector, in the real estate sector, but I think they're fairly contained and they're not going to put the whole market on fire in a negative way. So I'm not thinking, and unless like rates go like really bazooka and we are getting like a really sustained path of inflation back higher and far away from the 2% target, I don't think that the stock market will care much.
All right, Bloomberg's JP Barnett and the very dramatic Marcus Ashworth of Bloomberg Opinion. We thank you both so much. A little bit of bond and stock math. Coming up, we're going to get a little bit more of that. Ethan Devitt joins us, the chief market strategist at Moneta. Talk about whether the macro actually matters. Stick with us. This is Bloomberg.
Very short period of time. Every single child, every single student, everywhere on this planet will actually have access to a tutor, someone who can help educate them one-to-one.
In their pockets.
Right, and we know that one-to-one education is, in fact, the one that has the best value and the best outcome. So the idea that you can have custom to who you are, to your language, you know, male, female, young, old, relatable, you know, funny, serious, Shakespeare, whoever you want, can be your tutor, your teacher that you can learn from, just seems to me like such a amazing transformation across the globe.
This is Bloomberg.
Always on the heartbeat of the tech
spread across global markets.
The real-time data aspect is going to be important.
We're going to bring you expert analysis on that. Sure.
Don't miss Bloomberg's interview with the
To finish the job will take fortitude. We will need to resist the temptation to act quickly when patience is needed and be prepared to respond agilely as the economy evolves.
Welcome to Bloomberg Markets. You were just listening to San Francisco Fed President Mary Daly ahead of those Fed minutes on Wednesday. Let's get right into the markets here. Ethan Devitt, the CIO at London CIB, joins us this afternoon. I keep saying this morning. It is the afternoon officially, 2:12 here in London. Ethan, let's start with this bond market, though. There seems to be this question about what these rates are actually telling us at a time when Fed swaps are saying, look, rate cuts are just a matter of time. Why are yields on the surface not dropping more?
It's interesting. There was a discussion earlier about whether trusting the Fed is the right thing to do. And I'd say it's actually been the bond market that hasn't been listening to the Fed very much. They've pretty much been going in their own direction. So now I think there's perhaps a growing confidence, not in what the Fed is likely to do, but in the lack of necessity to do anything at the moment vis-a-vis rate cuts. We've seen the economy being extraordinarily resilient. And that's really what the bond market is looking to. Perhaps not the signals from the Fed, because it's kind of been ignoring those signals pretty much for the last 18 months.
What would they need to kind of snap back into focus to say, all right, well, this is the narrative that matters and this is the narrative we're going to trade?
Yeah, I'd say that right now we're looking, expectations are around the second quarter for the first rate cut. You're listening to the San Francisco Fed there, we heard the word agile and agility. And certainly with this level of rate cuts, the Fed has built in a lot of agility. They can swoop in if there's an emergency, if there's a crisis of confidence, maybe sparked by banks, maybe by commercial real estate, or they can hold fire and watch as inflation makes its way downwards as it has before. So I'd say right now, we are probably a little surprised by the size of those yields. We would expect to see bond yields trending down because we know that's the direction of travel. And as far as why everyone isn't piling into bonds, it's really because that sense of FOMO has never gone away. Certainly cash makes sense today. But when we look at other bonds, say investment grade or high yield, spreads are quite tight. And they're evincing a pretty I'd say risk on environment in terms of how tight they are. So for that reason, there has been a little hesitance around stepping into bonds because equities present just such compelling value, certainly in absolute terms relative to bonds today.
That's such an interesting dynamic because, say, 12 months ago, that was completely flipped on its head. Ethan, talk to us a little bit about this yield move, though. I'm obsessed with why yields aren't moving below that key 4% level. We just had Marcus Ashworth from Bloomberg Opinion on saying that yields could potentially hit 4.5 before they even consider 3.5. Do you see the movement in yields, the direction of travel going up before it comes down?
I do see it moving around a lot and being very volatile. And this is where we have to pull the lens back and look at some other factors that sometimes get ignored. Remember, we have multiple elections this year, over 50% of the world's population going to the polls. When it comes to elections, there's, of course, going to be a lot of politicking and electioneering and promises being made. And we do have this intransigent fact that we have government debt rising around the world and a demand-supply imbalance that could well lead to those yields being higher than they have been historically. So if we look at those macro factors, it is perhaps very real that people can see a supply-demand imbalance, and they can therefore perhaps suggest that the demand won't be there for bonds, and that's why yields need to be where they are. It's not where people expect them to be going. I think most people have been expecting that the yields will be heading down, but it's this hesitation, this lack of confidence. Maybe those funds are flowing into gold. Maybe they're going into Bitcoin. There's perhaps a suggestion that government bond is not the risk-free asset that they would have been in the past.
That's so interesting because one of my favorite fun facts, you mentioned the election, my ears immediately perked up. Obviously, I'm thinking about the U.S. presidential election first here because my favorite fun fact about it is that as soon as the election cycle of 2024 ends, the very first thing on the new president's docket is talking about the debt ceiling yet again. It hits in January of 2025. Ethan, is it too early to price in one, the election, a potential Trump versus Biden, if those do end up becoming the front runners, or two, the fiscal deficit concerns that are unassuredly going to be popping in about 12 months' time?
And they pop in from time to time and probably will pop in more before that even occurs. What we've seen, though, in the past is this has been, just like you mentioned, that insularity of equity markets right now. They are insulated from geopolitical fear. And they're insulated from this macro news that should be shaking markets, but it's not. So we do have occasionally a bit of a storm in a teacup around these budget ceilings and will they, won't they, and is the U.S. credit rating in jeopardy? And it just doesn't have an effect on markets because at the end of the day, it's the private sector that is driving sentiment around markets. There is a belief that government institutions will kick the can down the road as they have before. We now know that the central banks have the ammunition to help should they be there needing to inject some stimulus into the economy. So I really don't think it's going to be an issue. When it comes to the election, generally in the build-up to election years, as uncertainty clears, and we're going to have that around the candidates at least, the uncertainty clearing, that actually is quite good for markets. And generally, once the uncertainty clears around election time itself, that's usually quite good for markets. And neither side really wants to tank the economy. There's going to be every reason to pump out the good news between now and November in the US. When it comes to the UK, I think we have to remember it is barely a year since the crisis of confidence there and around the mini budget. So that's pretty much raw in many people's memory here. So I'd suggest there could be a lot more volatility in the UK and perhaps other countries. But the US, I see the same pattern appearing.
Ethan, ironically, we're having this conversation about who the next U.S. president could be on President's Day in the United States. Ethan, talk to us about, is there any early indication of who the most market-friendly candidate could be, given that, to your point, neither one any of them around the world want to tank any economies. But for the United States, who's the more market-friendly candidate?
That's actually very difficult to say this time around, because traditionally it would have been the Republican candidate. But then again, the tax cuts are still in place. It's really hard to promise this is where the fiscal, as was the extenuities really become an issue, because it's very difficult to promise more tax cuts when we've already had them. So again, little can be on the table around that. We can see these historically low unemployment numbers. We can also see a very strong positive growth of the economy, and we're seeing that reflected in the stock market with the S&P breaching new highs. So really, it's both sides actually looking at this particular set of candidates could point to a very positive outcome for the stock market.
That is music to a lot of stock market bulls' ears who are perhaps worried that there is perhaps too much momentum in the S&P 500 right now. Ethan Devitt, CIO at London CIV, we have to leave it there, but trust me, I could go hours and hours with you. We look forward to having you back on the program. In the meantime, we go from the macro with Ethan to some of the micro stories. Apple facing a fine in the European Union over music streaming. We have the details next. This is Bloomberg.
This will probably go down in history as one of, if not the largest financial crimes ever.
I cannot imagine a scenario where $8 billion just disappears.
Bankman-Fried has pled not guilty to multiple fraud charges.
Sam was just too important in the crypto community.
When someone says, I'm going to give $1 billion in the next 2 years, like that catches everybody's attention.
As time went on, their ideas got weirder and weirder.
I don't think he even had almost a conception at some point that it was wrong or right. I think he just had the mentality that he has to win.
This committee will not stop until we uncover the full truth behind the collapse of FTX.
Sue, Mark.
Are you in?
I'm in.
I'm in.
We're in.
Will this be the last of its kind? No. This is the nature of capitalism. Get over it.
Could face bigger challenges next.
It was going to keep Rain World Cup. This is a 3
as the economic picture.
covering the intersections of Hollywood, Silicon Valley, and beyond.
Welcome to Bloomberg Markets. Let's talk about one of the big stories in tech right now, or perhaps not so big. You tell me. Apple will face a European Union fine close to 500 million euros over the regulator's investigation into allegations that silenced music streaming rivals, including Spotify. I want to bring in Bloomberg's Alex Webb on this story. It's really my favorite part about these EU regulation stories is the fine, always, because 500 million euros is also how much Apple makes in about 11 hours. Does this matter?
So the money matters because it's still a big fine, right? And it's money that flows into, European Union coffers. As you say, it is money that Apple can quite easily cover given the scale of the company. The bigger implications, of course, what it means more generally for Apple's business. And this is essentially what is at issue here is that Apple charges typically a 30% royalty fee on any purchase made through the App Store. So Spotify would then prefer people to sign up via its website, where, of course, it doesn't have to pay that fee to Apple. What Apple was at least banning was if you opened the app, Spotify, tried to sign up, Spotify was not allowed to say it will cost you $10 here or $12 here, I think it was, but it will only cost you $10 if you sign up on our website. That was something that Apple forbade. And so the European Union is cracking down on them for that. Now, the question is, this is part of a bigger sort of chipping away at Apple's services business. In fact, more broadly, at so-called gatekeepers. These are the huge tech companies that are the gatekeepers to big platforms. iOS is such a platform. You've also got Meta with Facebook and Instagram, Google with search, Amazon with its online store. So Apple and the European Union has been for some time now trying to chip away a little bit of their dominance and targeting what it perceives as the anti-competitive behavior.
The fact that they are the gatekeepers, to what extent has the EU kind of made some progress in that? If Apple changes the way they operate in the EU, does that necessarily mean they would make the same changes in other parts of the world?
So not necessarily. Some people think that they might. We've seen it certainly with the charging port in the iPhone, which is now USB-C globally.
Don't get me started.
But that is something that is essentially, that makes sense from a scale perspective. It's rather than having to retool multiple production lines, you can see why that is easy. In fact, Apple might be tempted to admit that USB-C is actually a better technology, perhaps, than Lightning was. It's just slightly older. When it comes to these software solutions, where you have a different, app store in Europe than you do in the US. In fact, in most of the countries in Europe, you have a different app store. So they are not necessarily incentivized to do this in other parts of the world without there being a regulatory sort of stick beating them as much as there is a carrot enticing them.
In terms of then kind of where Apple would amend some of their other businesses, they do a little bit of everything: Apple TV, streaming, etc. I'm putting you on the spot here, 30 seconds. Is there any other kind of weak spots in Apple's business that might catch the eye of the EU?
So the thing that actually they're starting to make changes to is the way they use NFC, near-field communication, for payments, right? You've basically only been allowed to use Apple Pay if you wanted to make payments with your phone. It looks like that is going to be changing. Other people are going to be coming into that space. The reason that stuff is significant is not necessarily because of the money Apple makes directly, but because it makes your iPhone sticky. It's harder to trade in your iPhone the more products and services you have built into it. It's harder to trade it in for an Android. If that starts to get to fray a little bit around the edges, and let's be very clear, Apple's competitive moat here is very significant, then it gives consumers a greater opportunity to trade their iPhone in for an Android device without as much discomfort.
Okay, something to watch from Alex Webb on the Apple story, really kind of driving us through all of the stories that we are getting from one of the big tech names. We thank you so much for joining the program. Coming up, we switch from Apple to oil. Oil slipping from the highest level in about 3 weeks. Concerns over the demand outlook. And we're going to hear from Aramco CFO on what that looks like next. In the meantime, you are seeing Brent crude trade at an 83 handle, NYMEX at about 79. Starting to see that spread actually close between the two world's largest benchmarks. Stick with us. This is Bloomberg.
You formed a partnership with Penny Pritzker at some point to do parking, is that right?
Yeah, so when I was working at JLL, we went through this real estate recession in the early 90s, and the senior people at the firm said, let's do a retrospective on all these different asset classes to see what happened, how we overpaid, why we ran into so much trouble, what really happened in the marketplace. And when I did that, I recognized, wow, there were a lot of reasons why I liked the parking assets better than I did office and retail and industrial. And so I started really noodling on the differences between those asset classes and came up with a rationale to start a business in the parking space. But I crossed paths with Penny Pritzker, who later became our Secretary of Commerce. And she liked the idea, and she and I went off on this adventure together and built a real estate operating company in the parking space.
Welcome to the world of decentralized finance.
You can see the massive gains for the OG crypto coin.
The breakout we have all perhaps long awaited finally realized. We'll see if it sticks.
Bloomberg's covering all things crypto, the people,
There's no question this industry is composed of some bad actors and some good actors.
the transactions,
Volumes have surpassed $24 billion per day.
and the technology.
Stop talking about the technology, start demonstrating the utility.
Bloomberg Crypto, Tuesdays. Fixed income fix. Watch Bloomberg Real Yield at its new time Friday at 12 p.m. Eastern right here on Bloomberg. Context changes everything.
Welcome to Bloomberg Markets. I'm Kriti Gupta in London. Saudi Aramco may sell bonds this year as financial markets have improved, and the company looks to sell longer-dated debt. That's all according to the state oil producers' finance chief. The CFO, Ziad Al-Morshed, spoke to Bloomberg's Vonnie Quinn at the Saudi Capital Markets Forum in Riyadh.
Last year, everybody talks about a challenging market. Last year was our second best year since the IPO.
Well, let me give you two figures. Citi has a price target of $60 a barrel. Bloomberg Intelligence says it would take $108 a barrel for Saudi to balance its budget quite happily. You know, obviously your preference would be for the higher one, but how are you prepared for the lower one?
Well, I don't run the Saudi budget, so what we have is $60 is well above our costs. We have a lifting cost of $3 a barrel. In fact, we started focusing very closely at it because in the past 4 years it has increased from $2.8 a barrel to $3.1 a barrel. I know it's insignificant, but to us it's a trend that we monitor. That is way far. The margins are huge for us to worry about this. So are we prepared for different ranges of oil prices? Yes, we are. And you asked earlier about supply and demand. We think today there is sufficient supply. We think demand has recovered. Last year, the estimates are that demand was at an all-time high. And this year, there's considerable growth by all forecasters. The world today is still depending on very little capacity. There's about 3.5%, actually 3% of world production that is in spare. And that is extremely dangerous to continue this into the mid to long term. If you recall, the problems that were had with gas is because gas didn't have any spare capacity. Oil is always a lot more stable, much less fluctuations because there is spare capacity. Well, the world is now down to 3% spare capacity.
Let me get this right. Are you saying we're at dangerous levels of spare capacity?
What I am saying is natural decline is, call it 6%. On 103 million barrels, that's over 6 million barrels per day of capacity that is lost every year that has to be replaced. So that is a Saudi Arabia every 2 years. And if it's a Saudi Arabia every 2 years, we have to ask, where is this coming from? It may not happen, the problem may not happen this year, next year, but if there isn't significant investment in supply, it'll eventually be there. We'll get there.
The Aramco CFO speaking to Bloomberg's Vonnie Quinn at the Capital Markets Forum in Riyadh. I want to stick with the oil story, though, and bring in Nadia Martin-Wiggin, director at Svelland Capital. Nadia, a pleasure to have you on the program. Look, it feels like a lot of people are talking about whether or not this geopolitics, whether it's in Ukraine, whether it's in the Red Sea, whether it's between Israel and Gaza, whether or not any of that's going to have any sort of read-through on the oil market. We're looking at kind of a trading range for Brent crude right now where it hasn't really crossed $85 a barrel in a very long time. Why aren't we seeing more of a geopolitical risk premium baked into the commodity?
Thank you. I think the market has been, very focused on the general macro picture and the situation of demand in China. And demand in China is actually much stronger than the general market perception would have you think. So in our view, we believe that oil is staging itself to actually break out of this range and move higher. We see strong demand in China. We see strong demand in India. We see strong refinery margins around the globe. So it shows that the demand for the final products is there.
What breaks it in the downward direction, though? What hurts oil here?
Well, of course, if we have a slowdown in the general economy, if we hit recessionary pressures from higher interest rates, but we've been waiting for these recessionary pressures to really hit the market for the last 18 months, 2 years. So that actually hasn't played out. I think when we think about the general risk premiums, the market has become accustomed to this feeling of war, and we are looking at inventories in oil, in metals that are very much about having stocks just in time. And as we draw down on those inventories, which we've seen in the last few months, in oil in particular, in December, in January, that starts to affect things as we see demand pick up seasonally. And this is, we've had strong demand for gas oil in the winter, but then we're going to approach the summer, and that's where we start to see demand pick up for gasoline. But in the meantime, we need refiners to run hard, and that is the price indication we're getting from refinery margins. So crude can absolutely strengthen from here.
In terms of those refinery margins, though, do they suggest some sort of dislocation that you are seeing even within, say, the benchmarks between Brent and WTI? Simply the fact that the United States may actually have more control on this oil market than OPEC has, just as a function of exporting. Is that going to show up in those refining margins in any way?
Well, right now, the U.S. has been hit by the fact that we had these winter storms, right, that hit in January. So that was a big shock to production. In November, we had the U.S., hit 13.3 million barrels per day of production versus, say, Saudi Arabia's 9 million barrels per day of production. So that has definitely shifted that balance of power. But now we need to see that recovery in the U.S. to have the shale patch actually producing. And that's something that is going to take some weeks. When we think about the end of the year forecast, last year, the market learned that the U.S. engine for shale is still on board. But now the market is forecasting 400 to 600,000 barrels per day of growth, December on December. So that's already priced in. Right now, where we are in terms of the comeback after the winter, the market might fall short of that in the U.S. The U.S. might not do that right now. So this is where, the refinery margins are still very strong. And when we look at the backwardation in WTI today, for example, it has steepened, right? So there is actually more demand for oil that is available immediately in the U.S. right now.
Nadia, in the corporate space, we've been seeing a lot of consolidation in the shale patch. We've seen major acquisitions from the likes of Exxon, Chevron, Diamondback Energy, and Endeavor, for example, more recently, kind of creating fewer players in the Permian Basin. How is that going to ultimately reflect in production?
So there are the benefits of scale. And this is when Exxon has spoken about its acquisitions, when we hear Chevron, they believe, Exxon, for example, they can bring on 1 billion barrels more oil from the Pioneer acquisition in the whole patch, right? But on the other hand, there are smaller players that are observing this, right? And this is when we think about the private players and what they see happening versus these big public listed companies. They should definitely be scared and worried because they are price takers. When we think about the service industry, right? So Exxon, companies like that, they can take on the biggest project. They can run their rigs. Currently it's 20 hours a day. We have a limit at 24 hours a day, but they're moving things forward. They're drilling 3-mile lateral wells versus 2-mile lateral wells because they just have the acreage to drill that far. That brings down their costs a lot. But then when you look at the smaller players who can't do that, that is a problem for them. We're also starting to see the AI boom come into this industry and digitalization, which will make drilling more efficient. But again, the biggest players can afford to do that the most relative to the smaller players. So we're probably going to see a further widening in some of these plays as to who owns them and what they manage to produce from them.
Nadia, in our last 45 seconds here, I want to ask you a little about positioning as well. There's been a lot of questions. I want to say even 6 months ago, more and more people were in the super cycle kind of basket that this was going to be the start of a really intensive 10 years for the commodity sector. It doesn't feel like that narrative is still there. In terms of positioning, what are you seeing?
So the positioning is definitely more balanced. I think the disappointment on that growth was really led by China and how that reopening would happen. The Chinese Lunar New Year figures, though, suggest that reopening is absolutely happening. And there's big jumps year on year and versus 2019. When we think about the general specter, I mean, most speculative positioning in oil is actually in the gas oil market right now because we're in winter, and that's where we have very low inventories. We expect that to roll forward towards gasoline and now especially towards oil now that we're through in February, the peak of refinery maintenance season. So we'll see more purchasing in the oil market by the physical market, which should then play into the speculative market as well. We see algorithms buying today, even though it's a holiday, because algos don't care. So that really passive, slow-moving, algorithmic-led money, they're just getting into this market now. So there's a lot of upside to come from here, with an immediate target of $90 a barrel if we look at technicals.
Oh boy, $90 a barrel. Nadia Martin-Wiggin, we'll leave it there. Director at Svelland Capital, we thank you so much for joining the program. Still ahead, we're going to talk about the geopolitics, some of which may be driving that bullish positioning. Europe tries to figure out how to defend itself and support Ukraine if the United States pulls back. We're going to dive into the details next. This is Bloomberg.
Names in climate finance are on Bloomberg.
I can't tell whether you're optimistic or pessimistic about climate finance.
A lot of great stuff is happening, but is it enough? No, it's not enough.
I'm biased. I'm a huge investor in both fission and fusion and hoping that it comes in time.
Transition is not going to be an event. It's a process.
But at the end of the day, it's the right thing for the planet, it's the right thing for the industry, and there is business opportunity.
Ask you about politics. You've been involved advising presidential candidates, I presume presidents as well. You ever have any interest in serving in a senior position in the federal government or running for office?
Absolutely, unequivocally, no.
The aggravation factor isn't worth it?
It's the aggravation factor, but it's more importantly is I don't believe there's any integrity in it.
So you do give money to politicians, though, because that's the system, but you...
It's part of the game. I think, to be honest, I think there's a need for a multi-party system in the U.S. to give more people a choice about where they can throw their voter support and their political support, but also to cause the country to sort of come together by having everybody have a role in deciding what is in the long-term best interest of the country. I've often believed that Black Americans as a people and as a voting bloc should adopt the same position that the original founders of the Congressional Black Caucus had in early 1970. Their philosophy was enunciated like this: Black Americans should have no permanent friends, no permanent enemies, just permanent interests.
From the world of politics to the world of business, Every weekday at 5 p.m. Eastern Time, hosts Joe Matthew and Keely Lines deliver news, insight, and analysis live from Bloomberg's Washington headquarters. Get the latest from and about politics' biggest power players at the end of every trading day. Balance of Power, live around the world every weekday at 5 p.m. Eastern, only on Bloomberg Television. Context changes everything.
He was an extraordinarily courageous and good man. This is a sad day.
I think it will be disastrous and a tragedy for human rights, democracy all around the globe. For the situation in Russia, it will only confirm what is the regime today in Russia. But I think that for all of us around and in different parts of the globe, it will be a tragedy.
It really, I think, put the spotlight right back on the U.S. Congress, which at this hour is considering whether to fund defensive systems for Ukraine. And the world is watching.
There will be consequences. We're going to look for other ways that we can hold Mr. Putin accountable for these actions. And we'll work with the Biden administration and the international community to make it clear that this is outrageous.
Welcome to Bloomberg Markets. I'm Kriti Gupta in London. A number of our guests there reacting to the death of Russian opposition leader Alexei Navalny. I want to bring in Bloomberg's Patrick Donahue for more on Ukraine, as well as our very own Roz Matheson and get an update on the situation in Israel and Gaza, as well as the fallout of the death of Navalny. Roz, I want to start with you here. There's been a lot of pushback in Congress, even in pieces of the EU and the European Commission as well, around just how much aid is actually going to be given and possible for Ukraine at a time when perhaps a lot of people aren't seeing the success on the battlefield that they may want. To what extent is the death of Alexei Navalny going to push a lot of that pushback back and create a little bit more incentive to get them that aid?
Well, it seems like Congress either way is pretty dug in at the moment on Ukraine, and that's, of course, a reflection, if anything, of the U.S. domestic political climate right now. And you can see those expressions of outrage at the death of Alexei Navalny across the board. You even see sporadic protests and vigils happening inside Russia. But above all it shows is that Vladimir Putin has been there for the long game. He's not going anywhere. He's going to be re-elected more than likely next month, whereas the U.S. election cycle late this year could be very, very disruptive as well for the rest of the world, including Europe. And so within that, where does Ukraine sit? And this question of aid for Ukraine, does it harden the view that, you know, Ukraine is fighting hard at the moment but not really getting anywhere and clearly running out of weapons? Does it change that dynamic? Probably unlikely. Does it change anything on the ground in Russia? Probably unlikely. Putin is very much in charge either way. Is it going to facilitate the flow of military aid suddenly from the US to Ukraine? Unlikely. You can see just very much the positions in the US are very set in, again, reflecting that domestic political climate.
Patrick, come on in here, weigh in on this. If we're seeing such pushback in the United States, how much of a success story are we seeing in Europe when it comes to the aid? For example, the Estonian Prime Minister saying that 100 billion euros in bonds to kind of support the war effort in Ukraine is necessary. Do others in Europe share that view, or is the 60 billion euros that have been put in the EU at the moment sufficient?
Well, if you look at the scale of what the Estonian Prime Minister Kaja Kallas called for, 100 billion, that wasn't exactly meant to be aid directly for Ukraine, but to bolster the EU's defense industry as a whole. But we are talking that sort of scale if the U.S. as a global player, as a key European ally, steps back. In terms of the politics, I mean, in the EU, when you start talking about joint debt issuance, there's a lot of taboos involved. Straight through the Euro crisis, you know, this sort of talk, at least in Germany right here, you know, the impression you got is it just wasn't going to happen. It took the pandemic to get joint bonds going. That did work to get the European Union back on its feet from that economic impact. But joint debt issuance for defense, that might be a whole different ballgame. There are certain countries like France who are generally in favor of that. It would be hard to get through that through Germany.
Patrick, what do defense capabilities actually look like for Ukraine? What has the ask been? What has Europe offered to provide? To me, I thought the headlines over the weekend was that Denmark said we're handing all of our artillery to Ukraine. What more do they need?
Well, yeah, I mean, picking up just on what Ross was saying, it's pretty, well, I want to say dire, but the mood was quite dark at the Munich Security Conference. Our people who were there talked to leaders and players who said the situation is quite grim. Ukraine needs ammunition. They need shells. They're running low on it. They're being outnumbered by Russian productive capacity, 3 to 1. There are different scenarios. There's stories that we have. But first and foremost, if you talk to the Ukrainian government, they're saying send shells, send ammunition first, send weapons. That's what they need because they're being so stretched on the front line. They're rationing ammunition. And this weekend, we certainly saw a focusing of minds with the fall of Avdiivka. That's a city on the front line in the east that's been under bombardment for straight back to the beginning of the war. If the Ukrainian forces can't hold those positions on the front line, this is why. It's because they lack ammunition.
Gruesome pictures coming out of that city. Roz, Patrick there was just mentioning some of the comments coming from the Munich Security Conference. The others that caught our eye was the Ukrainian President Vladimir Zelensky actually speaking about President Trump, inviting him to the front lines, but being very careful of any sort of criticism. Meanwhile, in the U.S., President Trump has faced a lot of criticism for being, as former Vice President Mike Pence would call it, a Putin apologist. For example, what is President Trump's line on Ukraine?
Well, his line very much is that if he was president again, this war would be over magically, just like that, very, very quickly, that somehow he, above all, would ensure that Ukraine and Russia sat down at a table and worked out some kind of solution. Not necessarily he would care what that solution is, as long as there is a solution to the war. So obviously that's something that, is raising some concern because Ukraine says it's not ready to negotiate. It doesn't want to negotiate. It's focused on trying to push Russia back out of its territory, and every day and week and month that Russia stays there and more establishes the fact of being there, the harder it is to get them out. You can see that just from the developments on the ground that Patrick was talking about in recent days. So the idea that Donald Trump can come in and magically unravel a war that's been going on for 2 years is causing a lot of concern, because what does that mean really? In essence, what he's saying is it would require Ukraine to give concessions, to essentially give up the land that Russia is now occupying, and that is the concern, that that's what he would do to get a deal done.
And again, it all comes on the backs of those comments of whether or not the United States wants to continue to provide, I think, 2/3 of the expenditures to NATO, and not to mention some of the allegations on space capabilities as well. There's a lot to digest there. Bloomberg's Patrick Donahue and Roz Matheson walking us through the developments and the impact that we've had over the weekend. Plenty more ahead. Stick with us. This is Bloomberg.
Regional sports networks. There's a lot of, it's a business that seems to be collapsing. Leagues have sort of toyed around with, should we do something ourselves? Some teams are doing like local TV and streaming. How do you see that shaking out?
So I don't think I'm right on this, but my instincts keep telling me this is what's going to happen. Because if you remember the WWE, they launched their own network that had their own content and had their own pay-per-views. And it was kind of a smart, bold, ahead of its time move. And then they pivoted at the perfect time and they sold their content to, what was it, Peacock?
Yeah.
And that was really smart too, because they were able to leverage that number as high as possible. So they always zagged where the money was and when the opportunity was. I think the opportunity for the NBA with the local teams would be to own all that themselves.
Welcome to Bloomberg Markets. Big banks reporting earnings this week here in Europe. Barclays just one of the names to report for the fourth quarter. Joining us now for a preview of what to expect, Bloomberg's Tom Metcalf all over this story. Tom, Barclays reporting results tomorrow. Walk us through what we need to know here.
Well, the big thing to know is there's this investor update coming alongside these results, and that will pretty much be what I think the market is going to be focused on. And it's essentially a strategy update, like how is Barclays planning on effectively positioning the business going forward. You've had the CEO, Venkat, there now for a couple of years, so I think this is really his first moment to sort of put his own imprint on the bank. And the big question is how drastic, how dramatic is that going to be? So far, all the reporting suggests there'll be more sort of fixing around the edges, marginal changes rather than anything too drastic.
Is buybacks part of that picture?
I think they'll certainly be mentioned, and I think Barclays has already been doing buybacks, also dividends. But what they'll probably be looking to do is paint a picture of many more capital returns coming to shareholders. We all know that will really help the share price. So I suspect that is a big lever they're going to pull.
Well, that's the Barclays piece of the equation. HSBC isn't exactly having a grand time either. They're also reporting earnings on Wednesday, I want to say. Buybacks in the picture there, too. What do we need to know?
Yeah, so HSBC, very Asia-focused. So I think over 2023, they'd already announced $7 billion of buybacks, a reflection of just how big that bank is. Analysts are expecting more. So, yeah, when they come through on Wednesday, Asia time, I expect NIM will have helped them. They should be having a relatively strong year. But the interesting thing is we've got reporting that, the CEO is saying, OK, 2023 is OK, but what I'm worried about is looking forward to 2024.
But in 2024, all right, I'm going to macro this out, Tom. If we were starting to see rates in the UK or in Europe or even in the United States still kind of remain a little bit higher for longer, even for the next couple of months before these rate cuts actually kick in, does that mean net interest margin has peaked here?
Certainly it's peaked in the UK. I think in continental Europe there might be a little bit more space for it to run. And of course, this is all based on predictions of what, the central bankers will do, right? But if expected, rate cuts are coming at some point this year, then, it's up, that sort of boom period for banks' top line is probably coming to an end. And it's all a question of, how do they manage those margins going forward? How do they keep on making profits, even if maybe those sort of interest rates are down a bit?
That's when I imagine the spotlight falls on investment banking, trading volatility, et cetera.
The costly bits, exactly.
Exactly. Bloomberg's Tom Metcalf from our finance team. We thank you so much for joining the program. There's a lot to digest there. Plenty more ahead. Stick with us. Coming up, Joe Gilbert, portfolio manager at Integrity Asset Management, joins Bloomberg Markets. Stick with us. This is Bloomberg.
Very short period of time. Yeah. Every single child, every single student, everywhere on this planet will actually have access to a tutor, someone who can help educate them one-to-one.
In their pockets.
Right, and we know that one-to-one education is, in fact, the one that has the best value and the best outcome. So the idea that you can have custom to who you are, to your language, you know, male, female, young, old, relatable, you know, funny, serious, Shakespeare, whoever you want, can be your tutor, your teacher that you can learn from. Just seems to me like such a amazing transformation across the globe.
This is Bloomberg News Now.
News when you want it at the touch of a button.
Another volatile day on Wall Street. We're seeing big moves.
All eyes on Capitol Hill as Democrats and Republicans prepare.
Today's job numbers casting doubt on the Fed's next move. Inflation remains front and center. And that's news when you want it with Bloomberg News Now. Get it 24/7 on the Bloomberg Business app, Bloomberg.com, and anywhere you get your podcasts.
Bloomberg News Now. Context changes everything.
Welcome to a special edition of Bloomberg Markets on this US holiday. Happy President's Day to those who celebrate, and for those who don't, you're stuck with me. I'm Lizzie Burden in London. Let's check on these markets for you at the top of the hour. The Stock 600 is currently higher 0.1%. Volumes, of course, are low because of the read across from the US. The FTSE 100 higher 0.25% almost. And as we look ahead to the Wall Street Open tomorrow, you've got S&P E-minis higher 0.1%. Really, we're waiting for a catalyst here. Anything that could move the markets. Could that be Nvidia's earnings on Wednesday? A fresh gauge, perhaps, of the strength of the US economy. If we flip over the boards, though, not a whole lot of movement in your bond space. You're looking at the 2-year bond yield currently they're not moving too much, pretty steady, and the Bloomberg Dollar Spot Index is currently not moving very much either. If we flip over again, you've got Brent currently there at $83 a barrel, weighing the tensions in the Middle East against the demand outlook, lingering concerns there as well. And iron ore getting a bit of a blow because of the concerns about the Chinese economy. This is after 5 days of gains. And you're also looking at gold holding pretty steady at just over $2,000 an ounce as the geopolitical risk rumbles on. So it's a pretty quiet day, but let's bring in Bloomberg's Sophia Ortega-Costa and Noor Al-Ali, two ladies who I'm sure can bring us some excitement on this quiet day. Sophia, I want to start with you. As our resident China expert here in London, China's back online after the Lunar New Year holiday. You've got this backdrop of negative economic clouds, and yet the CSI 300 getting a bit of a boost.
It did. So it did rise today, and it rose for a 5th day, which hadn't happened since October. I mean, that is not bad. Some people were expecting perhaps a little bit more of a boost, given all the measures that were announced just before the Lunar New Year. You know, as new securities chief, this kind of language that officials are using in Beijing to use more forceful measures to boost the economy. So perhaps there was an expectation of a bit more of a boom. We didn't get an interest rate cut from the PBOC on Sunday, which was a little bit of a disappointment to some economists who are predicting a cut. But again, you know, the deflationary story in China continues to be, as you say, the economic cloud over everything else. And even though markets came back with a little bit of a positive spin, there is some expectation that that perhaps was underpinned by national team buying, which essentially means that Chinese state funds were behind the buying and not real investment flows.
Well, speaking of the state, just interpret this for me. The Chinese premier is calling for pragmatic and forceful action to boost economic confidence. What does that mean? We've had this constant drip feed. Is this something significant?
It can be. I think the question is, what exactly will come out of this? And I think that if we're looking for a catalyst, early March will be when we perhaps will get one, because that's when we get the government work report. That's when China sets its economic growth targets, GDP targets for the year, and also kind of perhaps gives us a clue of how they plan to achieve them. But again, this language, this is the premier that at Davos, only a few weeks ago, actually downplayed the need for further economic stimulus in China this year. So what that will translate to when it comes to, what forceful measures he might mean, I don't think the market will expect anything like a big bazooka in terms of stimulus, because he's really, really downplayed the need for that in recent weeks.
Okay, let's broaden this economic conversation and bring you in, Noor. We haven't got so much echo data this week, but we do get the Fed minutes and the ECB minutes. What are you looking out for in terms of clues for the rate path ahead?
Yeah, absolutely. So obviously the minutes are a little bit more backward looking, but we'll also, traders will definitely be looking for statements or thoughts on where, the conversation is when it comes to loosening monetary policy. We also have PMIs coming out of this week, from Europe, US, and the UK. Those I find are, when I first started out covering markets, those are the first reports that I used to read, and I used to really take them to heart, because those surveys provide that kind of anecdotal evidence on where we think, inflation, the economy is headed. And right now, the question of consumer spending is really heavy on the mind of policymakers and traders alike. We had retail sales data out of the UK last week, surprised to the upside, the US surprised to the downside, but the economies are doing kind of the opposite thing, right? The US economy a lot more resilient than where we think the UK economy is at the moment. But I'm a lot more optimistic about the UK. I think, back in the day when I used to stay here with Guy Johnson, I think Alex would laugh and she'd say, well, yeah, absolutely true. There's a lot of pessimism baked in. I think there's more optimism as we look at forward-looking data out of the UK.
Yeah, we Brits are always down on ourselves, aren't we? But the ones who are most exposed to the rate path, of course, are the banks, and they're reporting this week, many of them. We've got Barclays tomorrow, Sophia, HSBC on Wednesday, Lloyds on Thursday. What's the highlight for you?
I think we're looking at where net interest margins are. That's a measure of profitability. We know that's declining, especially UK businesses, as the interest rate outlook changes here in the UK. I mean, banks do well under a high interest rate environment. I'm also looking at any color we can get on the housing market. Some of these banks are big mortgage lenders. We know that market is picking up. House prices have been a lot more resilient than a lot of people had expected. We didn't get those double-digit declines last year, Lizzie, and it seems that activity is picking up again. But we do know there's a little bit of a race to the bottom when it comes to mortgage lenders and the rates they're offering. So whether those businesses are being squeezed. Any updates on buybacks, whether that makes sense for this year, given where we are. There's so much we could say, but again, I think NatWest set us up for a very interesting week this week, because it did surpass estimates last week.
And of course, we can't talk about earnings without mentioning Nvidia, Noor. They're really going to be the highlight this week. I said that maybe they'll be a bellwether of the US economy. How much can we use them like that?
I think definitely a litmus test, right? There's a lot of optimism that's baked into the tech rally, AI. Everything's about AI. If you look at earnings calls and you do a simple word search, you'll see that AI references, machine learning, that kind of thing, really skyrocketing, and it shows you that kind of appetite that pretty much all sectors across the board are interested into incorporating, especially when we've got that kind of labor market that's quite sticky, So, tech definitely playing a big part of it. And if you look at the Magnificent Seven, they've not really been immune to those changes in yields. In particular, we're talking about the treasuries here. With the Fed's minute this week, there's a lot that could potentially sway the market here into a downside risk, especially as we've had these quite lofty valuations.
And I'm glad I've got the two of you here. We're all in pink and red, but I want to settle a debate, because both of you have been writing about the FTSE 100 today. Noor, you say that the FTSE, while it's cheap, can be a bit of an opportunity for investors who think there's going to be some sort of global economic slowdown. It's a defensive play. Sophia, you say, Goldman makes the point that even if the FTSE is cheap, almost half its dividends are paid in dollars. So a stronger pound ahead could be a headwind. Noor, what do you say to that?
So look, the pound has been resilient, right, to the volatility that we've seen when it comes to rate cuts. But ultimately, we are expecting the Bank of England to cut rates sometime this year. The pound hasn't really been as much of a gainer when you look at just how aggressive the Bank of England had been in maintaining its tightening policy. But I still look at the FTSE 100 as an opportunity now, and I really am changing my view when it comes to the UK market. I've been pessimistic, pretty much like Goldman and the likes of them, for much of last year for good reason. I still think that now 2024 is a new tide that's turning for the UK economy. And even if it's not, the FTSE 100 does provide that defensive sector play that could definitely play in the favor of those that are looking to potentially expose themselves to the UK at, very interesting valuations, I'd say, much cheaper than the global peers by like 40%. You'll also have the FTSE 100, they pay the highest dividend yield when it comes to earnings. I see a lot of optimism when it comes to the UK market. I don't know, Sophia, you got to convince me otherwise right now.
All right, well, you have to have it off air, the two of you. Thanks for joining me. That was Bloomberg's Noor Al-Ali and Sophia Orta-Acosta. Thank you, ladies. Coming up, Joe Gilbert, Portfolio Manager at Integrity Asset Management, is going to join us next. This is Bloomberg.
This will probably go down in history as one of, if not the largest financial crimes ever.
I cannot imagine a scenario where $8 billion just disappears.
Bankman-Fried has pled not guilty to multiple fraud charges.
Sam was just too important in the crypto community.
When someone says, I'm going to give $1 billion in the next 2 years, that catches everybody's attention.
As time went on, their ideas got weirder and weirder.
I don't think he even had almost a conception at some points that it was wrong or right. I think he just had the mentality that he has to win.
This committee will not stop until we uncover the full truth behind the collapse of FTX.
Sue, Mark.
Are you in? I'm in.
I'm in.
We're in.
Will this be the last of its kind? No. This is the nature of capitalism. Get over it.
On the heartbeat of the tech
spread across global markets.
The real-time data aspect is going to be important.
We're going to bring you expert analysis on that. Sure.
Don't miss Bloomberg's interview with the
It's always a mistake to overinterpret 1 month's number, and that's especially true in January, where calculating seasonality is difficult. But I think we have to recognize the possibility of a mini paradigm shift. The soft landing paradigm with the assumption that inflation was headed down to 2 in a tranquil, healthy, real economy has certainly been called into question by these data. I think the Fed is going to have to be very careful. They were never right to be focused on March for a cut. I had been saying that seemed premature, and they and the markets have come around on that. I think that May is odds off at this point and probably should be odds off. And gosh, I think we've got to recognize what no one's talking about. There's a meaningful chance, maybe it's 15%, that the next move is going to be upwards in rates, not downwards in rates.
A meaningful chance that the next move's a hike, says former US Treasury Secretary Larry Summers, who was speaking there about the outlook for Fed rate cuts. Well, let's get more on the market implications now. We're joined by Joe Gilbert, Portfolio Manager at Integrity Asset Management. Joe, what do you make of that? The next move, could it be a hike?
Good morning, or I guess good afternoon, Lizzie. Thanks for having me on. And, I think Secretary Summers is probably a little too draconian there. I don't think that we're going to have any more hikes. I think we're done with the hikes for this interest rate cycle. I think what we will have, though, is higher for longer, or probably just more normalized rates, which will probably is going to take a little bit of the steam out of the equity markets, and the valuations that are pretty peaky right now. So I think that we won't see another hike, but I don't think we're going to see cuts as soon as the market would like.
So when do you expect the cuts to start? You've got swaps pricing about 90 points of cuts in 2024, down already from 150 at the start of the month. But when do they start for you?
Yeah, I think probably, our base case now is probably sometime after the summer. So I think right now the first cut is in June, the market's pricing in. We still see that getting pushed back a little bit. And, what investors have to realize is, I think we started out the year looking at 6 potential 25 basis point cuts. Now we're down to, a little less than, 100 basis points fully of cuts. But I think that it doesn't really matter the amount. I think it's just once the Fed actually starts it, is actually going to be more bullish for investors.
Okay, so after the summer, and I suppose rather than ask you whether the US is going to have a recession, the question is, how has it not had a recession? You're looking at the inverted yield curve. Has that signal kind of lost its meaning?
No, I think the yield curve has been a little obfuscated just by a lot of the, QT that the Fed has done with its balance sheet. But, I think you're back to your original question about how the U.S. has avoided a recession thus far. It has basically, we've come out of unprecedented times as far as liquidity goes. And so we came out of the pandemic, and with that, there was a lot of liquidity that was pumped into the balance sheets of companies as well as consumers. And then you had this pent up demand that was also there. So I think that we still have excess liquidity in the system. The problem is no one really knows to a full, precise measure of how much excess liquidity is in the system. But I think that excess liquidity and excess savings that consumers have has allowed the continued spending to persist, despite what normally happens in this type of environment.
And Joe, you mentioned the read-through to the corporate story. Jay Powell has started talking about geopolitical risk in a way that he didn't really until recently, and the impact on monetary policy. But what about the read-through to earnings? Could we start to see geopolitical risk weighing on margins?
That's a good point. I don't really know right now if we'll see that immediately. Obviously, the biggest implication or the biggest transmission mechanism would be with oil and probably, I guess, now with the Red Sea impacting trade flows. That's going to actually impact, but it's going to probably be a little bit of a lag. So we won't see that. So, but that is actually a potential to actually bring more of a slowdown later in the year, not more so, in the first half of the year. So earnings overall won't be at risk in the first half.
All right, well, we've had Goldman actually saying, forget 5,000, you're looking at 5,200 as the level where the S&P is going to end the year. It seems to just get higher and higher. When does it stop? When do we actually start to see a bit of a pullback for U.S. equities?
Well, Lizzie, trees don't grow to the sky, right? So, we're actually a little more cautious near term here. And we've had a powerful rally from the back, last half of the year, most likely, we're pretty much the last 2 months of last year. And a lot of that was baked into the fact that investors were expecting a pull forward of rate cuts. And, that allowed valuations to expand, that allowed the market to broaden out. And, leadership from the high-flying tech stocks resumed, as well as, the smaller cap and mid-cap names that hadn't participated. And so a lot of that just really got pulled forward. And we just think that it's time for the market to take a pause. So, we're not looking at anything really draconian, but we really think that the market's probably going to be a little sloppy here over the next, and that's a technical term there, just over the next, between the spring and summer, before we probably resume a little bit of a rally, because we'll get closer to Fed cuts then. We'll be past a lot of elections that are going to be happening globally, and you'll have a seasonally strong part of the year.
I like that. There's just one more thing I've got to ask you, Joe. Most people say they wouldn't touch the regional banks with a barge pole, and yet you, in your notes, say they're starting to pique your interest. Why?
Yeah, I think that, we go where everybody else has already left, and that's where you're going to get the opportunities. And so I think that with regional banks, their troubles have already been pretty much declared. And, their existential risk that they previously had of last spring, we don't think exists anymore. The credit story has been out there and they've reserved. And if we actually get to a point that rates have peaked and the Fed is going to come and play, in the next 6 months, then you actually get a tailwind for housing again and for mortgages. So I think that overall, and the valuations aren't demanding, and they're going to be able to return more capital than I think investors expect, despite the potential for regulation.
All right, Joe Gilbert of Integrity Asset Management, thank you for joining me on President's Day, and with all the technical terms sloppy included. Coming up, we're going to hear from the Bank of England's former chief economist on why he thinks the Bank of England should pivot to rate cuts now. That's next. This is Bloomberg.
You formed a partnership with Penny Pritzker at some point to do parking, is that right?
Yeah, so when I was working at JLL, that we went through this real estate recession in the early 90s, and the senior people at the firm said, let's do a retrospective on all these different asset classes to see what happened, how we overpaid, why we ran into so much trouble, what really happened in the marketplace. And when I did that, I recognized, wow, there were a lot of reasons why I liked the parking assets better than I did office and retail and industrial. And so I started really noodling on the differences between those asset classes and came up with a rationale to start a business in the parking space. But I crossed paths with Penny Pritzker, who later became our Secretary of Commerce. And she liked the idea, and she and I went off on this adventure together and built a real estate operating company in the parking space.
Could face bigger challenges next.
It was going to keep Green World Cup. This is a 3
as the economic picture
covering the intersections of Hollywood, Silicon Valley, and beyond.
Why do the biggest names in business choose Bloomberg?
That is a great question.
It's a great question.
Great question. Great question.
That's a question I get all night.
Bloomberg, top experts, great questions.
The risks for me now firmly skewed towards the economy and towards the downside. And that's why I think, for me, this is the time that the bank should be considering very seriously withdrawing some of the tightening that it put in place over the course of the last 18 months to cushion those risks to the economy at a time where inflation now is falling at a fair old click, and I think set to hit target by perhaps Easter time and then remain around target. So for me, I think now is the time to be speaking a little bit more firmly about the need for cutting sooner rather than later.
Well, we're already in a technical recession. Are you worried that this could get even deeper if the Bank of England doesn't turn to cutting rates sooner?
I think that's where the balance of risks lies, yes. I mean, it's true that the data for this year so far, such as it is a bit brighter than the tail end of last year. The jumping off point last year to this year looks to be a more positive one. Surveys of businesses, surveys of consumers, surveys of housing, all pointing to a somewhat firmer start to the year. But I still think we're looking at a year at best of anemic growth, with the risks to the outlook still skewed pretty firmly on the downside. So for me, the case for putting in place some upfront early insurance on the monetary policy side is strong and strengthening. And I'm fearful we leave that insurance a little too late in the year.
So that was Andy Haldane, the former chief economist of the Bank of England. And you can check out more of that conversation with me on the Bloomberg UK Politics podcast, which is available everywhere you get your podcasts. Well, let's bring in Bloomberg's Phil Aldrich for more analysis of what Andy Haldane had to say. Of course, Phil, you've covered the economy forever. You'll remember that Andy Haldane was one of the biggest hawks on the Monetary Policy Committee. But there he is, saying that the BOE should cut now if he was still on the committee. Is there any way the BOE would cut rates before the Fed?
I mean, it does seem unlikely. I mean, the inflation problem we face is more severe than the Fed's, in as much as we cannot, even low rates of growth can be inflationary in the UK because, well, low rates of demand can be inflationary because we have a constrained supply capacity. So the economic capacity that we have in the UK is relatively low. This was the Bank of England's current chief economist, so Andy Haldane's successor. That was his analysis on Friday evening. So even weak growth can be inflationary because we cannot sustain, without generating inflation, anything more than about 1% a year. So I think, you look at what's happening in the US, they've got much, much faster demand growth. They've got much faster economic capacity growth. And so they're in a much better position, and also they should be dealing with the inflation issue first. It does seem they're in the position to be able to do that.
And Andy Haldane was warning about the recession risk. Of course, we got the GDP figures through last week showing that the UK is in technical recession. But before we got them, Andrew Bailey, the governor of the Bank of England, was saying that he wouldn't put too much weight, his words, on whether the UK was in a shallow recession. Do you think he'll mind more now that we've had the figures and they were worse than expected?
Yeah, I mean, that was the problem, is that this is the balancing act that they're having to make. This is a very difficult decision. On the one hand, you do have slightly worse than expected downturn. I mean, as Andy was saying, I think everyone is expecting that to have been it. So we've had 2 quarters of contraction, and we're going to return to growth, albeit relatively slow growth. But what you're looking at the moment is inflation. So you've got conflicting signals. You've got inflation actually coming down a little bit faster than the Bank of England was expecting, but this is only 1 month's data since their February, update. And you've got we're in recession. So those 2 things would suggest that yes, you should, you can start contemplating cutting rates soon. On the other hand, you've got quite a tight labour market. You've got wages rising faster than expected, and you've had very strong retail sales in the most recent data. And you're looking ahead to April, where you're going to have, there's going to be increases for minimum wage, people on benefits of the state pension, way above inflation. So all of these kind of pressures would suggest that
Phil, we'll have to leave it there.
Things could be inflationary.
It could be. Phil Aldrich, our senior economics writer, we thank you. Coming up, Terry Haynes, founder of Pangea Policy. He's on next. This is Bloomberg.
Let's suppose you're on a plane and somebody realizes who you are. They say, I have $100,000. I don't know what to do with it. where should I invest it? Where should they put their money?
So today, it's a easier decision than it was maybe 2 years ago, because Treasury bills are 5%. So I would say, regardless of how much risk you want to take, you have to put a portion there. Then you would have to ask, really, an individual is the same, I think, as any institution. What is your time frame? Do you need to get access to this $100,000 in the next few weeks, the next few months, the next few years, not until you retire? And that will determine your investment decision.
So what do you think is the most common mistake investors make when they have 100,000, $1 million, or whatever they might have? What is the most common mistake you have observed that investors make?
I would say hubris and thinking you know more than you do, because every decision that you make has many, many layers. So as you're creating a portfolio, look at the risk as well, not just excited about the return.
And what's the best investment advice anybody's ever given to you?
Continue to learn about innovation in whatever you do, because that is where it's not exciting, that's where returns will go.
He was an extraordinarily courageous and good man. This is a sad day.
I think it would be disastrous and a tragedy for human rights, democracy all around the globe. For the situation in Russia, it will only confirm what is the regime today in Russia. But I think that for all of us around and in different parts of the globe, it will be a tragedy.
It really, I think, put the spotlight right back on the U.S. Congress, which at this hour is considering whether to fund defensive systems for Ukraine. And the world is watching.
There will be consequences. We're going to look for other ways that we can hold Mr. Putin accountable for these actions. And we'll work with the Biden administration and the international community to make it clear that this is outrageous.
So that was a number of our guests reacting to the death of the prominent Putin opponent, Alexei Navalny. US President Joe Biden condemned the Kremlin for its role, but our next guest says his response was too weak. Joining us now is Terry Haynes, founder of Pangea Policy. Terry, what does the death of Alexei Navalny actually mean for the future of the war in Ukraine and the strength of Vladimir Putin? Are you pessimistic?
Well, I don't think that Navalny's death means very much to the United States debate over how to support Ukraine and how much, unfortunately. You have what you have in Washington is fundamentally a whole of government failure. There's a lot of focus right now on House Republicans because that's where the process ball lies. But you've had a situation in the United States where 2 years ago, the soaring rhetoric about Slava Ukraini and doing everything necessary has been replaced by a number of things. You'd not only dissension in the Republican Party about whether and how to support Ukraine, but also a situation where President Biden has not pushed out as much weapons and materiel as has been promised, and has not tried to lead, goad, and force the Congress actually to deal with Ukraine. And when it was time in November, for example, to deal with Ukraine aid, something that Biden said was an absolute emergency 3-4 months ago, he paired it up with border security, thereby almost guaranteeing it wasn't going to happen. And the only reason why the Senate ended up doing something on this earlier this month was because the Senate decided to unpair it. And told Biden so, didn't ask him. So what you've got here is a situation where in the highest geopolitical and U.S. political risk in 50 years. You've got a president that isn't pushing as hard as possible, and dissension on both in both his party and in the Republican Party on exactly who they should be helping, when, how, and why. That's a bad situation all the way around.
And meanwhile, Donald Trump says that if he wins the White House, he'd end this war instantly. What does that even mean?
You'll have to ask former President Trump about that. But I think the impression that he is trying to leave is that he is a strong leader that is much more respected on the world stage. Notice I didn't say liked, I said respected on the world stage. And none of this happened on his watch, and none of it would have happened if his watch had continued. We can argue about that till the cows come home. But what he's trying to do is trying to draw a line between the relative Biden weakness, which he's trying to hammer in as a political message, and relative strength, which is a mantle he's trying to put on.
Well, a key theme of the Munich Security Conference over the weekend was this fear that if Russia attacks a NATO ally and Donald Trump's back in the White House, that the US won't ride to its rescue. How realistic is that threat? I know that Biden didn't want to use the word panic.
I don't discount the fear and upsetment of European governments about potential Trump presidency. I will say that one thing that is not at all understood in Europe or in the broader debate is that to do what President Trump suggests is, among other things, illegal under U.S. law, and it was made illegal last year in a major defense bill. So as a practical matter, he's not going to be able to unilaterally withdraw from NATO should he become president, number one. Number two, for what it's worth, I understand that people read the news in Europe and elsewhere and express concern about whether or not Trump might be president. That's a real possibility, certainly. Today, I still have Biden, even after all his difficulties, squeaking through to victory in probably a three-party race. What you've seen in the United States race so far for the Republican nomination is Trump not able to unify his party, and very importantly, not being able to appeal to the majority of independent voters, which could be as little as 10%, as much as 40% of the overall electorate. If he doesn't do both of those things, he doesn't win. So, for what it's worth in Europe, I've tipped this as a little bit more pro-Biden.
Okay, well, let's turn away from Europe, because ING is warning that the tensions in the South China Sea could escalate if Trump wins, and that a Trump-led US might not stand up to China like Biden would. Do you agree with that?
I don't think that's possible to know for a number of reasons. Preliminarily, it's not as if tensions in the South China Sea aren't already high. I mean, as we speak now, both the United States and Chinese navies are running exercises, in the proximity of the South China Sea. So this is a very fraught situation anyway, and one that I think is underappreciated by markets. But what you have to understand about U.S. politics is that the composition of the Congress is as important or more important on many things than the presidency. And where the Congress is frankly, was last year and will continue to be, is more pro-defense and more interventionist than even Biden was. It was the Congress that insisted, for example, that defense spending in the United States be 3% higher than President Biden asked for. So what you've got here is a situation where the United States Congress will be a very forceful advocate for a robust U.S. foreign policy. It has been, is, will continue to be, I think, even regardless of the election. And what we will find, should there be a Trump presidency, is a Congress that is still very much interested in shouldering and executing its world responsibilities. Even in Ukraine, where there's some dissension, which we already talked about, 75% of the House of Representatives is in favor of Ukraine aid. So what you've got is a process problem here that I think gets overwhelmed by numbers. How that happens isn't entirely clear yet, but I do think it does happen.
And indeed, we've actually just had a headline crossing the terminal in the past few minutes, Terry, saying that the US is weighing sending bombs and other weapons to Israel. This is according to a report by NBC. It's really great to have you on the programme. Terry Haynes of Pangea Policy, thank you for your insights as always. Now, last week, we spoke to Democratic Senator Ben Cardin about the death of Alexei Navalny. Here's what he had to say.
Well, this is a tragic event. Mr. Putin is fully responsible for Mr. Navalny's apparent death. It is absolutely tragic. The Vice President spoke here at the Munich Security Conference, Vice President Harris, and repeated that there will be consequences. Mr. Putin's actions are just against all humanity. Mr. Navalny was the principal spokesperson for the opposition to Mr. Putin, and Mr. Putin decided that he had to be taken out, and that's outrageous.
Is there any actions that you intend to take from where you're standing, Senator, in terms of any future investigation or anything?
There's many options. There's many options that we can take a look at. As you know, we've already are engaged in action because of Mr. Putin's invasion of Ukraine. So that we've already taken sanctions activities against Russia. But there are other, we're going to speak out about this. We're going to look for other ways that we can hold Mr. Putin accountable for these actions. And we'll work with the Biden administration and the international community to make it clear that this is outrageous. It violates all basic rights. And Mr. Navalny will not be silenced. His cause will live on. And we're all going to fight for the Russian people that Mr. Putin now has a grip on.
Well, your committee has already backed the United States going after Russian assets, freezing them, taking that money, and making sure they can give the windfall from that money to Ukraine. Where are we in that? Your committee has backed the administration from doing it, but so far, nothing has happened.
Right. Well, the assets are frozen. Now, whether we'll seize them, we passed legislation that would allow the government, the U.S. government, to seize those assets and use them to compensate Ukraine for the damages. The United States holds a small fraction of Russia's international assets. Most are held in Europe. So we need to work with our European partners if it's going to really mean something in helping Ukraine from the point of view of the financial compensation. So at the end of this war, Mr. Putin needs to be held accountable for his war crimes, and Russia needs to be held accountable for compensating Ukraine for the damage it's caused. And we believe the assets that we have control over can help deal with that.
That was Democratic Senator Ben Cardin on Bloomberg late last week. Coming up, Supermicro Computer says a shortage of chips is hindering its sales. Part of our interview with the company's CEO next.
Regional sports networks. There's a lot of, it's a business that seems to be collapsing. Leagues have sort of toyed around with, should we do something ourselves? Some teams are doing like local TV and streaming. How do you see that shaking out?
So
I don't think I'm right on this, but my instincts keep telling me this is what's going to happen. Because if you remember the WWE, they launched their own network that had their own content and had their own pay-per-views. And it was kind of a smart, bold, ahead of its time move. And then they pivoted at the perfect time and they sold their content to, what was it, Peacock?
Yeah.
And that was really smart too, because they were able to leverage that number as high as possible. So they always zagged where the money was and when the opportunity was. I think the opportunity for the NBA with the local teams would be to own all that themselves.
What happened was you were offered a money-losing women's basketball team, and you said, I want to be in the other sports as well. Is that right?
Well, yeah, you know, you got to be smart about this.
Welcome to the world of decentralized finance.
You can see the massive gains for the OG crypto coin.
The breakout we have all perhaps long awaited finally realized. We'll see if it sticks.
Bloomberg's covering all things crypto, the people.
There's no question this industry is composed of some bad actors and some good actors.
The transactions.
Volumes have surpassed $24 billion per day.
And the technology.
Stop talking about the technology. Start demonstrating the utility.
Bloomberg Crypto.
Welcome back. Now, shares of Supermicro Computer are riding on a historic rally fueled by none other than artificial intelligence. Supermicro makes data servers for chip makers like NVIDIA, who of course reports this week, and shares have more than tripled since January. First, CEO Charles Liang tells the host of Bloomberg Tech about the strong market demand for servers.
Basically, we are able to build enough server for our customer. But now, as you know, the chip shortage. So once we have a more supply from the chip company like NVIDIA, then we can ship more to customer.
Let's talk about the chip makers, the NVIDIAs. But you're kind of agnostic here, right? You take chips from Intel, you take chips from NVIDIA. What are your relationships like?
Okay, indeed, we both companies are founded in 1993. So both companies are 30 years old company. We start to work together almost since day one. So with 30 years relationship, engineering, partnership, and then go to market, define the market spec. So we have been working very closely. However, we hope they have more chip available.
Charles, do you have a number, a dollar value for the total addressable market that you see for your company in the context of an AI infrastructure build-out?
You know, we always facing to a big back order. So the market size is growing. Right? As you know, AI boom basically just start. We believe the market have a big room to grow, and lots of industry leaders have the same feeling. So as of today, our production capacity can support our revenue up to $25 billion, for example. But we need more chip, like what I just mentioned. So again, the market continue to grow, and we continue to get market share because of better product, because of rack scale, plug and play. So we are continuing growing our production capacity in United States and globally as well.
For our Bloomberg television and radio audience, we're speaking to Supermicro CEO Charles Liang. Charles, when we said that you were coming on the program, our audience had many questions. One of them is about the SEC action taken against your company in August of 2020, the SEC charged Supermicro and the former CFO of the company with what they called widespread accounting violations and some numbers presented by the company. Could you update our audience and your investor base on where that process is and if you've put those concerns behind you?
Oh, yeah, those concerns have been behind us for many years. So first, we study detail, hey, where we can improve during that few years.
So that was Charles Liang, CEO of Supermicro, who looked pretty happy, and I'm not surprised. He was the biggest percentage gainer on the Bloomberg Billionaires Index, I've just learned. Coming up, Ken Wallace's big bet on the Middle East is starting to pay off. We'll bring you to our big take story next. This is Bloomberg.
Very short period of time. Every single child, every single student, everywhere on this planet will actually have access to a tutor, someone who can help educate them one-to-one.
In their pockets.
Right, and we know that one-to-one education is, in fact, the one that has the best value and the best outcome. So the idea that you can have custom to who you are, to your language, you know, male, female, young, old, relatable, you know, funny, serious, Shakespeare, whoever you want, can be your tutor, your teacher that you can learn from, just seems to me like such a amazing transformation across the globe.
Always on the heartbeat of the tech sector.
Spread across global markets.
The real-time data aspect is going to be important.
We're going to bring you expert analysis on that. Sure.
Don't miss Bloomberg's interview with the
Welcome back. Well, Dubai International Airport passenger numbers surged 32% year-on-year in 2023, surpassing pre-pandemic levels. Well, Bloomberg's Vonnie Quinn landed an exclusive interview with the CEO of Dubai Airports. That's Paul Griffiths. Take a listen.
Well, what we do is invest very intelligently in new technology because airport infrastructure is very expensive and quite difficult to build, particularly on a constrained site such as DXB. So what we do is invest in new technology to speed people through the airport, because without building anything, if you can actually double the rate of capacity throughput, you've doubled the capacity of the overall airport. So that's a very intelligent way, because of course I haven't met a single customer over the years I've been in the business that actually wants to spend more time at an airport. Usually the interface with the product, if it is efficient and quick, that wins us more plaudits from our customers than any other single factor.
Presumably you would then need more slots. How slot constrained are you right now for airlines?
Runway slots, we still have a little bit of capacity left on the runways. Aircraft stands, we're still okay at the moment, and there's a program to build some more. Passenger processing capacity is probably our biggest single barrier to expansion. But as said, you know, the involvement of everyone in improving the process and investing in the technology to measure the customer journeys and optimize the performance at every single pinch point through the airport, that's one of our most, I think, successful and key focus areas for the entire business.
So that was the Dubai Airport CEO, Paul Griffiths. And sticking with the Middle East, the billionaire banker Ken Moelis is starting to see a return on his investment in the region by making some major compromises and taking major risks. Moelis has managed to take advantage of the frenzy of deal-making in the area. Gulf IPOs have raised more than $30 billion over the last 2 years, and Moelis has worked on more than half of those that hired independent financial advisors. For more, we're joined by Jennifer Serrain, Bloomberg Middle East finance team leader. Jenny, Moelis has been banking on this for years. He's been building these relationships, maintaining those relationships, but can they weather the current geopolitical storm?
I think that's really the most important facing this expansion drive right now. So you're absolutely right. This is a company that has been in the Middle East for many, many years now, stuck by it through some pretty controversial times, has expanded pretty massively. And yeah, so now this latest, obviously with the conflict going on in Gaza, really puts that determination to stay to the test. But what I do think you've seen is this is an area that there's not a lot to get excited about in investment banking right now. It's pretty quiet markets, very little deal making, very little capital markets activity globally. But this is one area where there's just so much activity, so much, client desire and demand. And so I think that's where you're seeing this tension is the fact that they're drawn to how much activity there is, but then obviously it's a region that comes with so many risks on the geopolitical front.
Well, when you speak to analysts, how much upside are we talking here?
It's definitely, it's interesting because it's the one area really around the world right now that's growing. And so that's something to get excited about. But obviously it still pales in comparison to the types of revenue you can generate in a place like the US or even here in the UK. And so I think for the most part, all these banks would like to see a pickup in activity that's a little bit more broad-based. But for now, they'll take what they can get in terms of, Dubai being as popular and as exciting as it's been.
And as you get more rivals muscling in on the Middle East, how much is Moelis's first mover advantage being eroded?
I think it's a place actually that really values loyalty. And so I do think that will matter long term. But it's a really good point. You're only as good as your bankers are. You're only as good as your last deal. And so as more of these banks try to get in, if they steal some talent, if they end up doing more innovative types of deals for these clients, I think you could really see some competition here for Ken Moelis.
Have any of his bets in the region spectacularly failed?
No, I think that's what's been so interesting is as he's put more talent on the ground and as he's tried to really plot a bigger expansion beyond just Dubai, really, like he's really interested in getting into Riyadh and Saudi. I think you've really only seen them benefit. And so I think that should continue as long as the kind of booming markets there continue. But it's definitely a unique place because obviously it can have such high highs and then obviously such low lows in terms of activity levels. So
all right, well, it's a fantastic big take. I do recommend you all read it. That's Bloomberg's Jennifer Serrain. Thank you for telling us more about it. I just want to get a quick look, a few of the movers before we head towards the close of the European trade. You've got AstraZeneca and Rheinmetall. They're both up over 3%. Why? Well, AstraZeneca's had this trial data showing that its blockbuster lung cancer drug has actually managed to slow disease progression. And then Rheinmetall is, of course, the German defense company. It's announced plans to open an ammunition factory in Ukraine, and it's been ramping up production since the 22 invasion as we approach that 2-year anniversary of the war. They've signed a memorandum of understanding at the Munich Security Conference, and traders are backing the move. Finally, Santander up this morning after it unveiled that €1.5 billion buyback after the record profits last year. Of course, Santander, one of the biggest beneficiaries of the ECB hikes, and they forecast that that's going to continue. Well, coming up in the next hour, we're going to be speaking to Société Générale Global Chief Economist Klaus Bader, whose pronunciations are hopefully better than mine. That's up next. This is Bloomberg.
this will probably go down in history as one of, if not the largest financial crimes ever.
I cannot imagine a scenario where $8 billion just disappears.
Bankman-Fried has pled not guilty to multiple fraud charges.
Sam was just too important in the crypto community.
When someone says, I'm going to give $1 billion in the